Good morning and welcome for FESE Convention 2021. I'd like to thank you for joining for what promises to be an exciting day of discussion and debate. First things first, and a few items of housekeeping first. The emergency exits from the room are there, and here. No, really, sadly, we couldn't meet in the one room this year, but that doesn't mean we cannot be organized. We will break up at 12:30 for an hour and a half, and the live stream will pick up automatically when we resume at 2 p.m. To submit questions, please use the comment box on the right of your screen. As we are live streaming via YouTube, you will need to be logged in with your Google account. However, if you're experiencing technical difficulties, please get in touch with our FESE Secretariat. Right, with this out of the way, let's look ahead for the day in prospect. As a FESE president, let me briefly reflect on what I would hope is a takeaway for you today, apart from many current issues we will be discussing. And this is the value of exchanges and their role for economy and our societies. Exchanges as EU financial market infrastructures play a central role in serving the real economy and providing capital for the companies by delivering neutrality, transparency, reliable price formation, and risk management. I want to highlight the extraordinary value of the price formation process delivered by exchanges to the benefit of all market participants. This is why exchanges dedicate substantial resources on maintaining the highest possible standard for accuracy and reliability, with data coming from fair, transparent, multilateral pool of liquidity, open to all market participants under same rules, putting trust and integrity first. Some are trying to use alternative numbers and complexity, while I will only quote ESMA. Only 52% of equity trading in EU is conducted on venue. FESE believes that EU securities market should be made more transparent and simpler. In particular, the MiFID II and MiFIR review should address the current issues of complexity, opacity, and intransparency of EU securities markets. Now, let me briefly give you a short overview of our convention program today. Our first panel at 9:55 will center on the recovery and what is the right strategy for the development of competitive and attractive European public capital markets. We are then delighted to be able to welcome Slovenian Minister of Finance, Andrej Šircelj, for a keynote speech forecasting Slovenia presidency of the Council of EU. Straight after, panel 2 will focus on MiFIR review. And we will round off the morning with a speech by Kirstina Combe, Managing Director of the London Metal Exchange. Anthony Attia, FESE Vice President, will walk you through the afternoon sessions when we'll pick back up at 2 p.m. In a couple of minutes, Riess, FESE Director General, will take over as our Master of Ceremonies of the day. But before that, on behalf of FESE, I'm delighted to introduce our first speaker, Commissioner Mairead McGuinness, European Commissioner for Financial Services, Financial Stability, and Capital Market Union. Thank you all, and Madam Commissioner, the floor is yours.
Well, good morning, everyone, and thank you for giving me the floor and indeed for your invitation to be with you this morning. And I'm happy to say here in Brussels, it is a very good morning. You have many items on your agenda, and I really want to give you some introductory remarks around key points that I'm sure we will be discussing into the future. So as I say, thank you for the invitation. I think, like many of you, I am a very strong believer in the important role of EU capital markets, particularly now for a sustainable recovery. I think during this pandemic, we've seen some of the weaknesses of the European economy exposed. In particular, we've seen that European capital markets are not developed enough and aren't providing enough sources of non-finance funding, especially for small businesses. And if we look back to the last crisis, we saw how the United States recovered more quickly than the European Union. And this was thanks in part to more developed capital markets. Advancing the Capital Markets Union can contribute to the recovery by providing deep, liquid, integrated capital markets. And it will widen access to alternative sources of funding for our companies beyond bank loans. It will give people, citizens, more opportunities and confidence to save and invest for the long term. But of course, the Capital Markets Union is not just about the recovery. The CMU is also about making sure that the European Union is globally competitive. We want to increase the financial firepower of European capital markets. And it's also about mobilizing the investment we need to meet our ambitious European Green Deal targets. And as we all hope and know that as vaccination progresses, we're looking towards that recovery. And I expect companies to renew their interest in equity issuances. Now to European capital markets, which today remain fragmented along national lines. And this means people and businesses are losing out on access to a large investor base. So what we need are well-developed capital markets, local capital markets that serve local needs, but are integrated into one single market for capital. And local stock exchanges are vital. The work that you do at a local and regional level boosts the equity ecosystems and seeks to re-equitize the markets. And integrating capital markets in the European Union is our shared long-term goal. But as you know, it is a long and complex process. It requires adapting the rules and creating the right incentives to foster the emergence of a capital markets union. We will continue to move step by step in all areas where barriers to the free movement of capital still exist. Making progress on the Capital Markets Union can help make European companies more competitive, particularly SMEs. We want to help these SMEs grow and support the European economy. We know that newly listed SMEs help drive new investment and create jobs. And there is evidence that companies recently listed on public markets often outstrip privately owned counterparts in terms of annual growth, workforce increase, and innovation potential. So we're looking at how we can support SME participation in capital markets. The technical expert group tasked with assessing whether listing rules could be simplified to help SMEs recently published its report. And we're now reviewing the 12 recommendations in the report and analysing their feasibility. We're also moving forward on an SME IPO fund. The InvestEU programme has been agreed, which means that we have been able to start negotiations with a potential implementing partner to move towards setting up this fund to help SMEs access public markets. A financial landscape that supports SME IPOs is beneficial for companies that are mature enough to seek equity financing. But it has positive effects beyond that too. It can also help companies looking for early stage financing, since the possibility of IPOs increases the attractiveness of small companies with growth potential for venture capital and private equity investors. If we want to improve the functioning of our capital markets, we need to make them more accessible to retail investors and more resilient in times of crisis. And that's why we will review MiFIR, the EU regulatory framework for trading infrastructures, this year. And since the application of MiFID II in January 2018, ESMA data indicates that there is now more competition in the trading of shares, more alternative venues, and investment banks offer trading in shares listed on European exchanges. And currently about half of shares are traded either on exchanges or the order books of alternative trading platforms, and the other half through internalizing investment banks or simply bilateral over-the-counter. We agree with FESE that more democratic access to basic market data is a sign of capital markets that work for all investors, big or small. We want to make sure that all investors have a comprehensive view of prices across all trading markets. The data exists, but it is too dispersed, too expensive, and too difficult for smaller investors to access. Increased competition has also resulted in increased fragmentation of data, such as the price of shares, because each venue publishes its own data. Rather than focusing on individual venues, we think the best approach would be to create a consolidated picture of liquidity on all of these venues across the EU by means of a single consolidated tape. Instead of many separate data feeds displaying shared data, there would be just one data feed with all the relevant data available everywhere in the European Union. And this single data feed would be a valuable comparison tool, showing where the best price could be obtained for buying or selling a share. It could also improve competition between trading venues by attracting orders to trading facilities with better prices and better liquidity. We plan to ensure that remuneration of the revenue generated by the consolidated tape will go to the data contributors that operate pre-trade transparent order books. Trading in the dark has to be reported to the tape, but might not get any remuneration at all. Dark traders might even have to pay a fee to the tape. This consolidated tape will generate a reliable data source for all transactions executed anywhere in the Union on a single screen for equity, bonds, and certain derivatives. It will give smaller investors the same level of market intelligence on prices and liquidity that currently only the big players enjoy. On exchange-traded derivatives, we know that FESE considers that open access would lead to less innovation because exchanges would not have an incentive to create new innovative ETDs. One of our key goals is to foster a liquid market in euro-denominated derivatives. We are assessing how this can best be achieved. Beyond our work on MIFIR, we're looking at how to enable the participation of retail investors in capital markets. Europe, as you know, has one of the highest individual savings rates in the world, but retail participation in capital markets remains very low compared to other economies, and this is a very inefficient use of capital. It's also not in the interest of consumers if they want a return on their investment. So we want to empower people to invest in capital markets with a framework that treats retail investors fairly, that builds trust, and provides sufficient investor protection. Early next year, we will put forward a retail investment strategy to put retail investors at the heart of our work. But I want to introduce to you now some of our main thoughts. At the moment, investor protection rules are set out in a number of sector-specific legislation, and these rules may differ from one instrument to another, may sometimes be inconsistent, and the cumulative requirement can be confusing for retail investors. So we will work to make sure that these laws are consistent. We'll also look at rules on inducements and disclosure. There is evidence that consumers do not read, understand, or get the most from information disclosed by financial service providers due to information overload or because documents leave out important information. So we'll consider amendments to ensure that retail investors receive clear, comparable information. And financial advice may sometimes be biased due to the payment of inducements. To ensure non-biased advice, we will consider rules to increase the transparency around inducements and further limit them. And we intend to address the quality of investment advice by looking at a possible certification requirement for investors and a potential pan-EU quality label for financial advisors. To ensure more tailored safeguards for our investors and reduce the administrative burdens, we look at the appropriateness of investor categorization in EU law. And we want to look at the challenges that arise from the increasingly digital retail investment environment. Recently, we launched a public consultation on the retail investment strategy, and I would very much welcome your contribution to that public consultation. Another reason we want to develop the Capital Markets Union is to support green investment. Under the European Green Deal, Europe aims to be the first climate-neutral continent by 2050. We will need a huge amount of money to get there, an estimated 350 billion euros per year just to get to our 2030 targets. Ultimately, sustainable investment is about making the right choices, so we need good information. And that's why we've proposed a new corporate sustainability reporting directive. And I want to focus on what's new in our proposal. So firstly, the directive would expand significantly the scope of companies subject to sustainability reporting. Today, only large listed companies with more than 500 employees are subject to sustainability reporting requirements. With the new directive, we propose that all large companies, whether listed or not, and all listed companies, small or large, will be subject to reporting requirements. There is a special regime for listed SMEs, simple requirements, and a 3-year phase-in period. This wider scope corresponds to increasing investor demands for sustainability information. Second, our proposal will require companies to report according to EU sustainability standards. If you look at today's landscape, companies can use any reporting standards, or all, or indeed none. It is very fragmented and confusing. We believe that by developing EU sustainability reporting standards, we can create consensus about the information that investors can expect. There will be one set of standards for large companies and a set of simple proportionate standards for listed SMEs. EFRAG, the European Financial Reporting Advisory Group, the Commission's advisor on accounting standards, will develop these new standards. But of course, markets are global. So we are mindful that we need global alignment on reporting standards. And we support international efforts towards these global standards, but believe that global standards should not limit EU ambition. The third point is to foster trust in sustainability reporting. And to foster that trust, we propose introducing a general audit requirement. Investors and other stakeholders must be able to trust the sustainability information being reported by companies. And in order to ensure that trust, we're proposing an EU-wide assurance obligation on sustainability reporting for the first time. We'll start with a limited assurance requirement, which is less costly and corresponds better to the current ability of the audit market. To sustain the EU's recovery and make our economy more resilient, we need to develop the Capital Markets Union. To do so, we need to facilitate SME access to capital markets and boost retail investor participation. The recovery can only be successful if we can create sustainable and inclusive growth. As you know, Europe is leading the way, but we know we cannot do it alone. And that's why we continue to work with industry associations such as FESE and our global partners. And I really look forward to continuing that important work with you to achieve our goals. I wish you a very fruitful conference and thank you for your attention.
Thank you very much, Commissioner. And I think what you really could hear is your passion for CMU, as well as, I think, achieving sustainability. And I think certainly the points you highlighted to improve capital market finance for SME, the access to capital, give better access and better information to especially retail investors, and how to make markets more democratic and transparent, how to ensure trust in reporting, in governance around sustainability. I think all these are certainly issues we'll cover over the day. I think a very fantastic speech to set the scene. Thank you very much, Commissioner.
Thank you. Have a good day.
Thank you. And we turn now to our first panel. We're, I think, a bit early. So let's see whether we have already everybody on. But our first panel concerning the recovery. And I would want to welcome our moderator, David Wright. Good morning, David. And I turn over to you. And I think we anyhow have a short video to be played. So I'm sure until we're done with that, we'll have all the speakers on board. Good morning, David.
Good morning, Rainer, and thank you very much. And thank you, Petr, for asking me to participate and chair this panel. I think the subjects that we're going to discuss are immensely important about the economic recovery, the strategy for developing a competitive and attractive public markets. Indeed, I believe that if we don't do that well, the European recovery will be delayed. So we're going to hear from a very distinguished group of panelists. But before I introduce them, as you mentioned, we were hoping to have a member of the European Parliament, Stéphanie Yon-Courtin, who is the Vice Chair of Econ. Very unfortunately, she has been detained by important parliamentary business, but very honorably, she has decided to record a video for us, and we're going to hear that now before moving on to the panel discussion. So let's hear from Stephanie, and let's thank her in advance for being so kind to give us her views.
Good morning, everyone, and apologies that I could not participate live in this discussion as I'm currently attending a shadow meeting on the digital finance package. Many thanks to FESE for their kind invitation. To answer David's questions, I would like to highlight that the European Parliament is looking at the CMU agenda from the perspective of businesses and of investors. This means that we will be approaching the CMU files with two simple questions. The first is, how can Europe businesses get more diverse financing opportunities? And the second question is, how can we rebuild trust of investors, in particular retail investors, to participate in capital markets? The first question on financing businesses is crucial for the current recovery phase. We have seen more and more European member states embrace the benefits of alternative sources of financing. They are looking far beyond traditional bank financing to relaunch the European economy. I hope this will turn into a momentum in the Council to finally take bold steps on sensitive topics such as the European single access point, debt equity bias in taxation, and of course, insolvency. The Parliament in Europe will continue to advocate for ambition on these topics as we have in the past years. But in my view, the second question is even more important. Trust in capital markets from investors and consumers is essential if we want funding to flow towards our companies. For retail investors in particular, we have a unique opportunity to change the investment culture in Europe. During the COVID crisis, the most privileged savers have increased their savings, and they are now looking for opportunities to invest. They should trust that financial advisors will work in their interest. We will, of course, have important discussions during the horizontal review of distribution rules next year, but I strongly believe that changes can happen in the meantime. The industry should lead by example on this with simple actions such as co-create investment strategies with consumers, no limit themselves to offering in-house products, and organize proactively conversation with consumers on the best use for their savings. This change of culture will not happen overnight, but we can all together work in this direction. I wish you a very lively discussion, and I hope to see you all in person soon. Have a nice day.
Thank you very much, Stephanie, and thank you very much for your message of ambition and trust. I think those are absolutely essential, and that you support a broad, strong development of capital markets, and that the Parliament will be at the forefront of that. Now, let me introduce and hope all my panelists are with me. First of all, we have Othmar Karas, member of the European Parliament, now the Vice President of the European Parliament. Othmar, I can see you. Very warm welcome. Good morning to you. I was looking at your CV, Othmar, and I just could not possibly do a resume in less than 5 or 10 minutes, and probably more. It's just an immense...
You can tell I'm a friend of you.
It's an immense record of service, and you've been a member of the Parliament since 1999. You're also a member of Econ, but importantly now also a Vice President of the European Parliament. My second panelist is Rodrigo Buenaventura, who is the chair of the Comisión Nacional de Mercado de Valores. Rodrigo, I see you extremely clearly. That's not so surprising since we're both in Spain. Rodrigo was formerly at ESMA. And if I could slightly embarrass you, Rodrigo, by saying he's a rising star on the European regulatory front. Third up is Florence Brandel, who is the Secretary General of the European Issuers. Florence, welcome. I see you well. Thank you for being with us. I've just checked on your website, a very good website, by the way. But you and your chairman, Luc van der Steen-Kiste, were extremely influential on me in the high-level forum on improving access for listed companies. And I'm sure you're going to talk about that and also about this latest SME paper that the Commissioner was referring to. So a warm welcome to you. And Thomas Buch, who is the Executive Board Member of Deutsche Börse, another old friend, somebody who is passionate about the subjects we're going to discuss, the recovery subjects. How do we get these markets to work better in the public interest? And we're going to start with about 5 to 6 minutes each on getting the right policies, the right issues. What are the key issues that really would allow public markets to play a bigger role in the economic development of the EU? 5 to 6 minutes each, if I may. Otmar, please start us off.
Thank you, David. Thank you very much for your invitation again. It is a pleasure to participate this important event. At this important event, I would like to raise 3 points on the beginning. First and foremost, there is no doubt the future of Europe needs capital markets union, but not only the capital markets union, also to complete the banking union, a true single market for capital across the EU. The capital markets union is good, it is important, and it is necessary for our citizens, businesses, and our planet. We need it urgently. COVID-19 is making it even more pressing to accomplish the CMU. Public money, including Next Generation EU and national financing, will help, but it is not sufficient. We need market-based financing as essential contribution for a swifter recovery and long-term growth, for a greener, more digital, more social, more resilient and more inclusive future, and for increasing the EU's global competitiveness and autonomy. The Capital Market Union is also a necessary addition to our banking union. I mentioned it. A strong banking sector needs well-functioning capital markets and vice versa. The potential added value is huge. 120 billion euros per year, nearly 1% of EU GDP, is the benefit of more integrated and effectively regulated EU capital markets, according to the European Parliament's Research Service. My second point, Capital Markets Union is not a sprint, it is a marathon, like the EU. We have made progress, but we are still far from the finish line. To reach it, small steps are not enough. We also need to make the bigger steps. 12 out of 13 legislative proposals of the first Capital Market Union Action Plan were adopted, some with more ambition than others. But major barriers remain, such as real progress on supervision, taxation, and insolvency laws. The European capital market is still far too fragmented. In the EU, we have 27 different company laws, 27 different national tax systems, and 19 different insolvency regimes. In the United States, we have one of them. In the EU, we have around 300 equity trading venues. In the United States, there are just around 60 for a much larger capital market. In the EU, there is a decline of initial public offerings, and while we have one of the highest saving rates in the world, a low involvement of retail investors with financial markets. If we want the Googles of tomorrow to grow in Europe, we need to act urgently. The good news is we know the cause of the marathon. We know what to do. Last year, we have put on the table good advice from the KMU High Level Forum, 16 legislative and non-legislative actions from the Commission, second DMU action plan, and around 70 ambitious comments on these points in the report by the European Parliament. While it is one of the smaller steps, also the recent capital markets recovery package is important. My third and last point on the beginning is Winston Churchill once said, "Never let a good crisis go to waste." In this spirit, we must act now. We need a strong political commitment, especially from the national governments, to swiftly implement the joint recommendations. Nobody can do it alone. We need to do it together. Our strategy must be to put pressure, to speed up, and to set clear deadlines. And that is the reason why I'm so happy that you initiate this conference again and to discuss the Capital Market Union's future. If we want to be successful, we should work simultaneously and two fronts. We need to realize the lower hanging fruits. That means regulatory action to make capital market financing more accessible to companies and citizens, while at the same time start working on the bigger issues. That means the architecture actions on supervision, taxation, and insolvency laws to integrate national capital markets into a single market. Throughout this marathon, you can count on the European Parliament and myself to continue to push for a strong capital market union. Thank you.
Thank you very much. I was delighted to hear what you said, your third point about fixing deadlines and to drive forward the process with early and quick agreements. I'd be very interested to come back to you later and ask you how we should go about that, because I think it is a crucial point. It's one I've made myself very often, but I very much like to get your political feel, if I can put it like that. Rodrigo, warm welcome again. So how do we get our public markets to be more competitive and attractive? Coming from Spain, this is seems to me an extremely important vector for long-term economic development. Rodrigo.
Good morning, David, and good morning to everyone. And first, thank you for the invitation to FESE and to you to participate in this panel. Well, I agree fully with what Mr. Karas said before, and also what the Commissioner pointed out in terms of the key importance of capital markets both for the growth of the European economy, but also for the transition that we need to cover, both in digitalization and on energy. And I think we are all on the same page here, but I think it's important to repeat the messages so that we gain conscience of how important this is. I mean, European companies have a financing structure that is simply not fit for purpose for this kind of tremendous investment that we need to do in our economies. They have way too much debt, and especially banking debt, and way too little capital. We normally refer to this idea of 30% of banking debt in the European companies' balance sheets compared to 8 or 10% in the United States. That is a huge difference. But it also means that there's a limit for their growth, because you cannot grow indefinitely only with debt. You need equity, and the role of capital markets in providing equity is absolutely essential, and we need to do our best to ensure that companies can access markets. So I think that is already a good starting point in terms of political agreement, I think. Now, in terms of what is more important, I guess each of us in the panel will have different, let's say, preferences or ideas of what is the key. On one side, I would say that one element that is not fully into the CMU plans, which is taxation, Mr. Karas mentioned it a few minutes ago, is an important element. Not so much in terms of harmonization of taxation of savings. I don't think that is a key element, but on the taxation instruments to stimulate companies to raise equity, to get less financing from bank debt and more through equity, and also taxation measures that incentivizes investors to enter capital markets. So we need to tackle the debt equity tax bias, an element that has been long detected in the European Union. We need to tackle the expenditures linked to going public or to listing and look for a favorable treatment. And we need to tackle the idea of stimulating investors to get into capital markets through some tax incentives. I know this is a delicate field in the European Union policy, and that is mostly national, but I think that we need a common drive on this element, because if we want to get serious about incentives, the word taxation cannot be outside that cocktail, let's say. Now, one maybe word of caution in terms of, coming from a security supervisor, we tend to be cautious people, no? Not conservative, but cautious. And what I think is fine, and it's important that we bring more SMEs to the market. I think it's important that we bring more retail investors to the market, so we broaden the capital base. And it might be useful that we reduce a bit the burden for listed companies in terms of information. Okay, if you take all those three elements individually, they all make sense. If you put them together at the same time in the market, you can have some risks. Less informed investors, smaller companies with higher mortality rates, and fewer informative elements are a combination that I think is something that we need to be aware of. And I think that there is a solution for that, which is to stimulate also, maybe through taxation or other measures, collective investments as a way to channel retail investment into a diversified pool of companies. Instead of buying one stock or one single share, allow collective investments to diversify and do the research that is absent in the market for those investors, and I think that could bring some value in the equilibrium of things from this perspective. And then I think we should be a bit careful on cutting corners on elements like market abuse regime, or on some elements of disclosure by investors in terms of disclosure by issuers to investors. So on elements like market abuse regime, insider lists, and so on, and I know that there is some proposals in the report that was published 5-6 days ago for improving the listing for SMEs. With that respect, I think we need to be extremely prudent on that, because the last thing we want is the integrity of markets to go down. We need vibrant markets, but also clean markets, and that is, I think, important in terms of the union. And then in terms of research, maybe as a last point that I would like to mention in this first round of comments, in terms of research, we have a problem in terms of coverage of research for SME, and even I would say for large companies in some cases. And in that respect, I think we need to go a bit imaginative and think of formula that allow maybe for sponsored research. I know that is also one of the other recommendations by this expert group report, in a pooled manner where several issuers put money for analysts to cover individually one of them, but so that we look collectively, so that we lower the conflicts of interest, and we look for a way out in terms of research coverage. That would be my first 3 or 4 initial comments, David. Thank you.
Very, very interesting, Rodrigo, as usual. Rodrigo, just to tell us, I mean, these tax issues that you mentioned, very important, no doubt about that. In Spain, is this being are these points being actively discussed in order to encourage more IPOs, more companies to seek equity capital, or is this, still rather dormant?
We've had only limited experience with that. For instance, you know that in Spain, certain tax rules are decided at regional level, at the autonomous communities level.
Yeah.
Some regions have introduced incentives in terms of deductions from the personal income tax if you invest in SME growth markets. For instance, the Madrid region did that, and a few others. It has had limited effect also because the size of the SME growth markets, at least in Spain, is still relatively small, so the choice is not that big. But I think that those have been, some interesting experiments that we can maybe try to measure the impact and try to think bigger and expand them somehow.
Thank you very much. Let me turn to Florence Prindet, the Secretary General of the European Issuers. Welcome, Florence, again. And I'm sure you're going to make reference to this SME report that's just been published, already mentioned by the Commissioner and by Rodrigo. So over to you.
Thank you. Thank you very much, David, for the invitation. Thank you, Rainer. And nice to meet you all. I would like to stress first the importance, which has already mentioned, is to have a coherence in the regulatory strategy towards the evolution of the capital markets. We believe that the best way to contribute to the financing of listed issuers is to have a proper framework, but having the right balance, the right calibration between the market players, including easy access and flexible access for companies to the capital markets. What we have observed is, despite some, range of optimism, still the negative effect of COVID-19 on small and medium-sized enterprise will create pressure also on the stability of the financial markets. It was already been mentioned, the weight of the capital market as a source to finance the European economy is lagging behind compared to other regions of the world, and not only US. And going further, we also observe a decline in the attractiveness of capital markets and more companies dislisting. The cost of listing has been brought forward as the main arguments driven by regulatory measures. But it's not only about that, it's also about the importance of the cost outweighing the benefits in some cases. The access also of the pool to liquidity and the expertise of the London financial place will become more difficult. And it has already also been mentioned by some of the panelists, the difficulty for issuers to comply with different layers of reporting, but not only about different layers, but sometimes overlapping scope, content, and sometimes contradiction between the needs of developing capital markets and the objective brought forward of some of the regulatory capital requirements for issuers to remain listed. So for us, importance of a stable regulatory framework to allow for long medium-term planning with side incentive. Taxation was mentioned, and we also, have welcomed this aspect in the report, despite the capacity to build on this is the challenge. But we believe also stability goes with duly consideration of further regulatory reform, so that companies can put their energy resource into recovery and starting to reshape their business activities, rather than only focus on the compliance with new regulation. It means then time for transition. We saw some examples of challenges or sometimes contradictions with the objective of the goal on efficient capital markets, unsustainable corporate governance, no urgency to further regulate. We think the current framework put on the table by the Commission recently, and also by the Corporate Sustainability Reporting Directive, already provide valuable framework to incentivize companies to progress to this sustainability transition. Development of best practices, also including corporate governance, should be considered and perhaps consolidated before putting in place new rules. A recent proposal has been discussed on public CBCR, which puts pressures on European companies and eventually, put forward to a competitive disadvantage when requesting to disclose further information, meaning less market, less investment, but also maybe less employment for Europe. And hasn't been mentioned, but the FTT, which is in the discussions, we have over the past year rejected this initiative, which we believe will harm capital markets alike. So what are the solutions to ensure the best use of capital markets for listed companies? The objective goal, indeed, we support that, is to facilitate both access to equity, but also debt capital into companies through capital markets, because there is evidence that companies' financing needs will be hardly met by the banking sector. Possible EU reform include possible relaxation to some of the rules of listing, free fall, dual class share structure, also issuing prospectus and other documentation, particularly for companies that are already listed. To encourage companies listing, for instance, on prospectus, in our opinion, secondary issuance should be exempted for an obligation to publish a prospectus. Issuers already publish both periodical and ongoing material information, and the scope shall include share and debt issuance, as bond investor even require less information than equity investor for investment decision. I heard the comments on the market abuse regulation regime considered by the legislature and to have a caution approved there. However, we believe that the definition of inside information should be clarified and probably narrow to make it more affordable for issuers, to better protect them from the possibility to delay, the disclosure. And also the broad definition raised many problems as the identification when the information becomes inside, but also the risk to publish information which is not yet mature. The management of inside needs is burdensome due to all the information that the issuers must gather in the file. So most essential information, the identification purpose, should be included, and issuers should be given the flexibility to determine which elements of personal data in the insider list are sufficient for that purpose. The threshold for managers' transaction is currently too low, and also the sanctions has been recognized also in the report issued by the Commission are currently not proportionate, despite the fact that they should be dissuasive. Last but not least, to promote the employee share ownership in Europe, not only improve both the motivation of employee and the participation in the proceeds of growing business, and it also enhance the understanding of the functioning of the capital markets. So to end the contribution, to promote the equity culture, to enhance capital markets, remove barriers is important for people, business, and our future. And I'm happy, David, to answer a little bit more in details about the report of the Commission later on. Thank you.
Thank you very much, Florence. Well, you've listed some important points there, and when we come back, I'd like you to tell us with a magic wand in your hand which three would really make the difference. We've all got long lists, but I think it's important we try to concentrate on the really key ones which are going to change the atmosphere, encourage more companies to list on public markets. Thomas Book from Deutsche Börse, an encyclopedia on all of these issues. Thomas, what are the priorities?
Yeah, good morning, David. It's a particular pleasure to be here on the panel and to be with all of you on this conference on this very important subject. And it's great. I mean, if I listen to my fellow panelists and also to the Commissioner making her intro speech this morning, it feels that there is really a lot of common ground here in the analysis of the current situation. But let me briefly recap a bit the bigger scene here. I think we all agree 2021 will be a critical year because the EU is challenged with huge funding issues. And we've heard that earlier already. Economic recovery and the public debt situation is a great burden. We are faced with investment into the Green Deal, and we are, of course, faced with funding innovations in a digital world. And all of this in a situation where the banking sector is increasingly constrained. So the role of the public capital markets is more important than ever. And it is very good to also here recognize that it is so important for the real economy and not something secluded. And I think also we hear the tone from the Commission that this view is definitely there. I've been working, I mean, David, you mentioned it, in the exchange sector now for more than 20 years. and seen the development. And let me at least briefly reiterate to you why am I so passionate and fond of our role as public exchanges. It is twofold. It is on the one hand to raise capital through public listing, through IPOs, and secondly, to ensure the price formation, the information efficiency for the allocation of investments into the best purposes. And these two functions, primary markets and secondary function, are intrinsically linked. They are very important and they cannot be separated. And if we look at the status quo, it was alluded to, of the European capital markets right now, it has massively changed in those 20 years that I've been active, and also first and foremost driven by many of the regulatory activities. If we look at where we stand today on the primary markets function in 2020, on the global IPO count, Europe had 7% of global IPOs, more than 60% were in China and in the US. And this also leads that we have a very weak market capitalization. It is in the EU 52% of our GDP. If we compare, for instance, to the US, it is 148%. And if we now look at the secondary market structure here in the European Union, we have to see it is highly fragmented. We have more than 250 venues that are active in the equity trading sector. And I leave it to you to think about how many of these are also supporting the primary market and IPO function. And we are in a very dark, opaque situation. Only 53% of the volumes are traded on venue. And if we look at the Eurostock 600, so the largest 600 shares, it is only 37% that is traded on lit markets. And that compares to the US, where it is around 64% in the S&P 500 or 81% on Nikkei or on Hang Seng. And that, of course, has a very bad impact on liquidity and on price formation. I think the good news is there is a lot of potential if we activate the European capital market to contribute to the funding and to the economic recovery. And it is great to hear from you, Mr. Karas, but also from the Commissioner, the great importance that is put on the capital market, that is put also on the Capital Markets Union Action Plan, which is the framework integrating the capital markets in Europe even further. And also that there is clearly the recognition of the strategic importance of the capital markets. But I want to clearly also highlight that CMU is one part, and it can only be successful if we look also at the core legislation and the role that MiFID II and the review that is upcoming place is critically important from my perspective. We need to set the right compass for fostering price formation, strengthening transparent and lit trading, and making sure that also all venues contribute to the price discovery. So achieving the objectives of the CMU, it is very important to sort of set a level playing field and get the balance right between the primary and the secondary market function of exchanges. We must ensure that all trading systems in the EU are contributing to the quality of price formation. And some of the exceptions that were granted in MiFID have really led to even small trades being sort of executed on dark and non-lit venues. And we must re-establish a level playing field. We heard earlier also the role of integrating markets with the consolidated tape. The large public exchanges already publish with a 15 minutes delay all the prices, and we need to make sure that all the venues that are active are contributing to this price formation to foster not only the liquidity and the efficiency of markets, but also in the end, the IPO activity that is so important. And lastly, I want to, of course, to shed light here on the role that the MiFID legislation plays, but I fully subscribe, Rodrigo, to also the points that you made. It is so important that we re-equitize the funding by also getting a right balance in terms of taxation, in terms of the framework for companies to seek public funding on public markets. And happy to discuss all of that further. Back to David.
Yes, well, we will take up some of these points. Just one question Thomas, in Germany, do you consider the taxation of the balance between debt and equity needs changing fundamentally?
Yeah, I think we have still an unlevel playing field for the funding via IPO or via equities for companies versus debt funding. Debt funding plays a very important role still. So, and taxation is, of course, an important part of that. And this is the side of the sort of the company funding. But if we look at the equity investments, I think the same is true. I mean, the private households in Germany, only 17% are invested in shares. That is far too low. If we look at institutional investors, it is around 25% that is invested in equities. That is far too low. So from that perspective, if we hear discussions about introducing financial transaction tax and others, I can only say we need to set the right course to make it more attractive to invest in equities and also to use equity funding for companies.
Thank you very much, Thomas. I want to take the first thing you said, and I fully agree with what you said here, which is that listening to all of you, and indeed the Commissioner and our distinguished member Stephanie at the beginning from the European Parliament, there's a lot of common ground. I really don't. Of course, there are some issues where there are different orientation, but there's a lot of common ground here. And we've been saying this for really some time. So I want to turn to what Othmar said and to get his view on how do we politically move this forward. You mentioned deadlines, Othmar, and I think many of us would agree with that. But how do we actually shift? How do we actually shift the dial here? Somebody's got to take some initiatives. Is that going to be the European Parliament? Should it be the Commission? The European Council, all three? How do you see this?
Yeah, thank you for all these comments and for the common ground. That is also very helpful for the political work in the European Parliament. To your questions, 3 brief comments. Firstly, the Commission Action Plan has a timeline, but the timeline is only concerned to the proposal, not to the adoption. So our main interest must be to accept this timeline not only for the proposal, we need also a timeline for the adoption by the Commission. The most pressing challenges need capital markets union to understand the reality, and some of you mentioned it, is the best pressure for me. We need 660 billion euros of additional investment per year until 2030, just to meet our climate and environmental targets. We need common standards such as a EU Green Bond Standard to achieve this task. The Capital Market Union is not only about the recovery from COVID, it is also about mobilizing investment into our future. That is the reality. Is for me the best pressure to understand the reality and the necessity. To understand the citizens want solutions, not promises. Without market-based financing, we will not be able to reach our common goals. You mentioned it, Green Deal, digitalization, social issues, and others. That is my first point. My second point is, from the side of reasons, I am optimistic. From the side of the political will, I am realistic. I will not use the word pessimistic. I am realistic. what is the lack of the political will? In some of these cases, we need the unanimity blockages in the council, or we have a blockage in the council. We have to look to the German elections. That is important for the timeline. Also to look to the French elections. That's important for the timeline. And we have a new political reality in Hungary and in Poland and in the Czech Republic and some others, and nobody knows what's going on in Italy. And so that is, as a matter of fact, we need you to create the necessary awareness and to put pressure on the national governments. And what we need is, that is the political reality more than in the past. We have a lack of political leadership to do the right things. And that is the reason why we need a public debate and the public pressure and the pressure by the citizens to the national governments to do that what is necessary and what is right on the European level. And that is the reason why your conference is so important. And for this point, I think we must put the citizens at the heart of the capital market union. To be able to succeed, one key element is more financial literacy, more public debate. On the one hand, a recent Eurobarometer survey found that only 7% of consumers, I read it now, purchased a financial product in another member state. And 71% of consumers did not change a financial service provider over 5 years. At the same time, trust in financial services remains low. Financial services is repeatedly ranked as one of the worst perceived markets from a consumer perspective. On the other hand, the annual performance of equity UCITS in the last decade was with 9% much higher than the low or negative interest on savings. And in the last financial crisis, the United Nations recovered more quickly than the European Union, thanks in part to more developed capital markets. That are my answer to your question. The reality is on our side, the political willingness is not on the same level, and the public knowledge about the necessity is our major problem, and that is helping the pessimistic or the very restrictive activities on the national level vice versa to the action plan by the Commission. The Commission must make pressure, and the politicians must be united, and the public debate must going on. Thank you.
Thank you very much. I fully agree with your eloquent words here, and I think it is difficult to generate the pressure, if you, as you use the word, from the citizens. But I think there can be more pressure from the Commission and more pressure from the Parliament on the member states to drive this forward. And I go back and remember when Jacques Delors set timetables for delivery of the single market and was ruthless in delivering them, that the mood changes once these agreements start to be made and people really say, wow, Europe's on the move. And what you said about the need for this additional capital beyond the new generation is absolutely right. I don't think enough people, frankly, understand this. and I don't think enough political leaders understand it. That's enough from me. Let's move on to a subject which is really important in this context, and a number of you have mentioned it, which is small and medium-sized companies. Now, Rainer's notes for this meeting described the situation as saying that the guts of Europe are being ripped out by us developing lots of good ideas, lots of good companies, and these companies then go off to list in the United States, often becoming world-beating companies. There have been a number of examples very recently. So what are the key issues? I want to get at this very precisely. What are the key issues we have to get right in order to keep our small companies to develop and list on public exchanges in Europe? Who'd like to start? Rodrigo.
Well, thank you. I don't think there is a magic bullet, honestly, in terms of stimulating these companies to go public. I think there are a number of elements that we can discuss, and some of them are included in the report we've been mentioning several times this morning. For instance, in the technology sector, a lot of entrepreneurs, all quite young, to at least from my perspective, but have a peculiar vision of what capital markets contribute to the business, and they think that their ideas, their projects, the brilliant ideas for apps or any other technological improvement are worth more than the financial capital that equity holders put. And in some occasions that might be true. And we might be coming to a kind of a shift in the paradigm of the principle of one vote, one share, one vote. And probably multiple voting schemes, let's say loyalty shares or multiple voting shares, can play a role if we manage to let's say, restrict those to new IPOs of these type of companies. So I think that in general, one share, one vote should be the way to go and is the best principle overall. But in certain sectors, in certain entrepreneurs that might be thinking of jumping to lit markets, these might play a role. Then, of course, we need to lower the cost of going public in two dimensions. No, one would be to avoid imposing on listed companies rules that are not exactly linked to market discipline and that are different from non-listed companies of the same size. It can be sustainability, it can be some kind of governance, it can be auditing rules. If there are some rules that are important for certain size of companies, let's avoid making distinctions on whether you are listed or not, because if the difference is that step is very big, some companies might decide to remain in the unlisted world. At the same time, in terms of reducing the cost of going public, I think we need to also be cautious on that in terms of the information from the investors. I really think that the problem of going public and getting listed is not the cost of the prospectus or the fees of the supervisor. The other day I took the exercise of taking the last 10 IPOs in Spain. I know this is not very representative of the whole EU, but at least it's the experience I have. And in those 10 IPOs, I have the figures here, 65% of the cost was underwriting fees by the banks that were leading the books, let's say. 65%. 30% was financial and legal advisors. And the 5% was the rest. Compared to market cap, okay, I'm using market cap in the denominator. Out of that 5%, the fees of the supervisor, in this case the CNV, were 0.01%. So the cost of going public is mainly the commissions that you pay the bank to do the underwriting and the commissions you pay the bank for the financial advising and the lawyers. Now, we can. There are ways to cut that. For instance, the trend of SPACs, special purpose acquisition companies or conduits. I think they are an intelligent way for some types of entrepreneurs that could prefer a private negotiation and decide whether they go public or not once they know the conditions, instead of going out there and find out the conditions the last day of the IPO. And in that respect, I think Europe should be a bit more active on these. And on that, I think taxation is also, again, an important element, because we have the EU tax merger directive that specifies in which conditions you can defer the increase in the value of the assets in a merger. And I think we should apply that consistently to SPAC deals. So I think there are a number of elements that can, let's say, help to overcome that fear of doing the jump to the public market. But at the same time, we need to ensure that we don't diminish the quality of the information that the investor has to take the decision, because the investor, and just 30 seconds, I finish this. Mr. Karas mentioned trust and financial literacy, and I fully agree with that. At the same time, I heard the other day Mr. Giegold saying, and I agree with him, not every European wants to become an expert on equity markets. Sometimes they simply want to trust their independent financial advisor to help them pick a stock. So we need to also ensure that the financial system, has independent advice that, investors can use and can trust if they don't want to go and, study the big corporate finance book that some of them might not, be wanting to do.
Very interesting figures from you, Rodrigo, especially 65% of the cost being fees of the bank, underwriting institutions, 30% financial legal, but I guess 30%, that is based on having to comply with European law. Florence, how do you react to those figures of Rodrigo?
Yes, thank you. We can only confirm, the information that Rodrigo mentioned. One of the solutions that we welcome in the report, Empowering EU Capital Market for SMEs and making listing cool again, is some recommendation of proportionality in the prospectus as well, to have a simplified prospectus for issuers, a little bit alongside a recovery prospectus could be adopted eventually for a permanent basis with limited pages. I know limited pages doesn't mean necessarily that you have a decrease of the cost. It's important to have the proper relevant information. Another aspect that it's very core to our heart is the idea of transition. I think it's coming up, further in different proposals that are on the table. It starts to gain momentum. I think it's the way to allow companies, and you mentioned, David, the fact that they would move away from the capital markets. If you allow some transition on some of the measures, then companies, can comply at a moment in time when they need to concentrate on their business.
Transition, which
transition on the transition towards the regulatory compliance. We think it's important to have the possibility to adapt to the new requirements for a certain period of years in order to, feel and to explain eventually, why they are taking this time for adaptation in their, early growth phases. We also think that the definition, and we are very happy that it has been considered, the definition of what is SME, or we want to actually have a definition that consider companies under a market cap of €1 billion considered as small and mid caps, so that they would be submitted to a similar level of regulatory requirement. We also observed, the difference of regime between small cap listed and non-listed. We should question ourselves, whether, for instance, on sustainability reporting with the ultimate goal of the EU, to reach climate neutrality, it makes sense to have a difference of regime there, and we question this point. We think also it's important to consider outside companies operating in the EU and to question ourselves whether they should be submitted to different regulatory requirements, which is also the case, for instance, on company for the proposal on corporate sustainability reporting directive. And finally, I already mentioned that we also welcome in the report some simplification of the market abuse regime for small and mid-cap companies in order to have more proportionality and a better environmental for them. Thank you.
Okay, very, very good list of things. I want to ask Thomas about something. He used figures quite right about the difference between the EU and the US. So one thing that's always struck me, Thomas, is that in the US, they have a massive private pension scheme. The 401k, I don't know what percentage that is of the investments from 401k plans into the equity markets, but it must be massive. How important is it for Europe, in order to boost our public market, to develop pan-European and indeed national private pension schemes?
Yeah, and I think that is a very good point, David, and also to the earlier discussion on SMEs, which is certainly picking up on all the right points. It is always a topic of supply and demand, and we need to strengthen investments, institutional investments into the equity markets. And of course, these are also critically fostered by pension plans that are equity-based, where I think Europe is far back in many countries. Certainly Germany is lagging behind, that we activate that institutional capital. I think that is critically important, that we make sure that much more investments channel into also SME companies. If we look a little bit deeper into sort of the maturity cycle of a company, we find there are many innovations, there are many startup companies in Europe, and there is also startup funding improving. If we go into the late stage funding, we see a lot of reliance on foreign investments. We see a lot of strategic assets, but we also, of course, see that the dependency on foreign capital is significantly high, and that also leads, of course, to a very small number of, in the end, IPOs coming. So fostering institutional investments in equity is critically important, and it is the same as I earlier said, to make sure that we have the right balance between the primary and the secondary market functions, that we re-establish a level playing field also in the secondary capital markets, that focuses on creating liquidity and showing liquidity by reducing the dark and opaque trading for those institutional investors to be confident to invest in equity markets as well, so that liquidity is there and visible.
I've always had a dream, going way back to when I helped publish the SME venture capital work under the Santé Commission at the end of the 1990s. I've always had a dream, really, which is somehow Europe can bring its exchange smaller cap, particularly smaller cap markets together, not necessarily into one, but into a sort of common trading format, which would deepen liquidity for SMEs and become a very attractive, let's call it a Euro SME venue. Is that just a pipe dream, or do we just let markets, I mean, for example, there's some important initiatives in the Nordic areas, NASDAQ up in the Nordic doing well, but is there some way we can find a common platform, bringing together all the liquidity, not necessarily the trading, but bringing together into a big pool? Thomas, what do you think? Is that impossible?
I think it is. Yeah, I think it should be a focus, right? And the role also of the exchanges is to build that ecosystem. For Deutsche Börse, for instance, we've built the venture network, which brings together investors and also those small startup companies that are looking for investment. It's the largest venture network in Europe, bringing issuers and investors together. And I think, of course, it is important to bring this also into a European format to create that ecosystem. And that is really, I think, what changes unique, what we are doing. And I think further initiatives are on the way, the European single access points to foster the exchange of company data. But it is even more importantly to focus on the private market stage and building those ecosystems that eventually then nurtures the companies to also go public on exchanges. That is also why we believe work like a venture network that we've put on for years now and creating that ecosystem is so critically important.
I recall, I'd like to ask all of you this, and then we have to close very shortly, but I recall talking at Eurofeed to the president of NASDAQ at the time, not so long ago, about a year and a half ago, and I said to her, what was the one thing you would do to improve and deepen the liquidity and performance of European capital markets. And her reply was, build a European single access point. Do you agree with that, Thomas?
I don't believe that it is the one silver bullet that solves all the issues, if I may say so. I certainly think it will foster transparency and also accessibility. I think if we study the Scandinavian markets, we do see some good recipes that we can follow. And you alluded to, for instance, the pension plans that's there, also fostering SMEs, investments in companies by institutional investors, which are supported there. It certainly also includes other aspects like taxation. So I think there's a lot to learn, that you can build a successful ecosystem when you sort of have a bundle of measures. And I think it is needing a broader bundle of measures, and many were I think, rightfully mentioned today and discussed.
Thank you. Rodrigo, what do you think about that?
Well, so I mean, a European single access point, I think, is a good idea, and I fully support it. And from CNV, of course, we have always supported that project. But I don't think it will be the most important element in revitalizing the European capital markets in terms of access for more companies and so on. So if I look at the national scale, I know it's different, but let's take a big market like Spain in terms of equity and in terms of the size of the economy. We already have a Spanish single access point. All the information of all listed companies are in one place, which is, by the way, the website of the CNV is a public free service. Now, that has not actually stimulated Spanish investors to invest in Spanish companies just because they had a simple, easy access to all that information. I think the fundamental problems for more companies wanting to go public and more investors wanting to invest in equity are more linked to the structure of investment, as Thomas was saying, the role of institutional investors and pension funds, linked to taxation problems or the lack of taxation incentives, and also a bit of a fear of some entrepreneurs of going public for several reasons in terms of exposure, transparency, and so on. So I think it would help, but I don't think it would be the bullet point, the magic bullet to solve the problem, honestly, David.
Thank you. Very interesting what you said. Florence, briefly, and then I'd like Othmar to close.
Yes, thank you. Thank you. Yes, we think it's, it provides the ESAP is providing better access for investors of information if it has to, be put in place. But we have some, careful points that we would like to mention. First, to be defined, what information will be there. Are we building on existing OEMs? Are we going to ask further requirements for companies? It's really a question. Further reporting formats, then I don't think this will be really, beneficial for companies per se. So we want to really, put the question to the discussion and not having new additional pieces introduced. And also it's important that companies actually won't be held liable, further into the chain, whether, liable for information transmitted to their own national competent authority, but not towards, further transmission of information. So I think the discussion still needs to continue. Maybe this is not the first priority as issuers. Thank you.
Thank you. Yeah, I think it has to be, it doesn't have to be additive. I mean, the last thing you want is another layer of information on top of already quite a heavy burden of information on companies. So I don't think it's ever been conceived like that. Othmar, when you listen to this discussion, are you more persuaded in your final comments about the need to drive this forward? You're one of the leaders of the Parliament. It seems to me we have, as Thomas was saying, a great deal of common ground. You made the political points that you hope reality will drive it forward, but it may need a bit more, is my point. May need a catalyst to trigger this. Give us your final thoughts.
What we discussed is not only focused to the capital market union. I think it's our general problem in the European Union. we need a broader picture. And we need a broader public debate. We cannot only turn only one screw. We have to turn many different screws as a way to realize our common picture. I was rapporteur for the relation between CMU, small and medium-sized enterprises, and the Capital Market Union. What was my biggest problem at the beginning? That was that the name Capital Market Union, because the small and medium-sized enterprises are 90% credit financed, and they thought the Capital Market Union is only to finance the real economy via stock exchanges. So we have to understand that the Capital Market Union is an instrument to finance our real economy and to find a balance between the different instruments to finance them. That is not only credit, that is not only a stock exchange, that is a balance between the different instruments we have. And that is the reason in all the name was not very helpful to bring the small and medium-sized enterprises on board. And there was a first reaction to be against. And so we have to that is the reason why we have to turn many single screws, not only on the financial sector, and we have to debate publicly what the European Union needs to achieve our common goals. And all what you said, we need a platform of common business, a platform of all different instruments we need, and a public debate. What is the reason for the initiatives of the Commission for more competitiveness of the European Union in the world, and to achieve our common goals, from the digital, about the green, to the social issues we mentioned. We all have an instrument in our hands for the common program of the European Union, and that is what we have to do.
Well, thank you very much, Othmar, and let me thank this distinguished panel, which composed of Othmar, Rodrigo, Florence, and Thomas. I remain very optimistic on much of the substance of this, as I think we've seen. What I think is badly needed, and Othmar, I think, would agree with this, is political urgency, but also a wider debate. This is a societal debate. Developing our public markets is good for Europe, both economically, politically, but also for society. It will actually increase welfare, increase access for poorer people, and that's what we want to do. We want all ships to rise on the tide, but we need public markets, clearly, to do that in the right conditions, in a proportionate way, as Florence has been saying. So let me thank you all again. I'm handing back now, I hope just about on time, not too late, to Rainer, who's extremely accurate with his timing. And so let's look forward to the rest of the conference. Thank you very much.
No, thank you very much, David. And I think fantastic moderating job. And also thank you to the distinguished panels. I think for me, it was very much a debate about a wake-up call. And I would very much agree. As Europeans, we need to be much more ambitious. We need to, I think, put pressure on probably all levels of political leadership to act, because there is a lot of stake. There is the future wealth and employment of European citizens. at stake. And I think we saw we're in a dark place in many parts, too fragmented, too many venues, too dark, too little equity, too little empowered retail investors. So certainly this was very much for me a wake-up call. I'm now very pleased to be able to invite the Slovenian Minister of Finance, Andrej Šircelj, to take the floor. Minister.
Good morning.
Good morning.
Good morning.
Good morning, Minister. Good morning.
Good morning.
The floor is yours.
Good morning, everybody, distinguished guests, ladies and gentlemen. First, I would like to thank Mr. Riess for inviting me to speak here today. I'm very honored to be among the participants of the Federation of the European Security Exchanges Convention 2021. Unfortunately, we cannot meet in person, but I hope this will soon change. Times such as we are experiencing now make us rethink every aspect of our lives. Often such contemplation results in pondering of how the future will look like and how we secure better living conditions in the years to come. Here in my speech today, I will speak about the priorities for the upcoming Slovenian presidency to the Council of the European Union in the area of the ECOFIN Council. Within those, I will focus on sustainable and digital finance that will be of high importance not only during our presidency, but in the course of next years as well. I will conclude by touching upon the Capital Markets Union. So let me first focus on the upcoming Slovenian presidency. The priorities will follow the Council's 8-month program, the program of the German, Portuguese, and Slovenian trio. We will take over the presidency in exciting and demanding, but also promising times. We will do our best to continue with the successful work that has already been done. The main focus will remain on the recovery, the exit from the crisis, and a successful implementation of the recovery and resilience facility. In the area of taxation, we will focus on the digital levy and the carbon border adjustment mechanism. In the area of financial services, the spotlight will be on sustainable and digital finance, anti-money laundering, and counter-terrorism financing. We will focus on Basel III and Solvency II as well. I'm also aware that the work on long-term priorities remains important. The latter include a high level of ambition of sustainability and digital finance and on completing the banking union and the capital market union. Let me now focus on sustainability. From the beginning, the European Union is trying to find a balanced approach among financial and non-financial sectors. It is only right that the sustainable and inclusive growth is high on our agendas. Climate change is one of the greatest challenges that we are facing, and we must find sustainable countermeasures to tackle it. The urgency of the issue is increasing as the cost of delayed action rises. The EU recognized the need for action. It has taken the initiative to provide for a cleaner and healthier future in the global level. It has made the European Green Deal a top priority. This is good news, and I recognize this as much needed a step in the right direction. Financing of this new paradigm and different treatment of resources must go hand in hand as well. I believe that it is important to think in terms of sustainability in the field of finance as well. That is why we will focus on the agenda of sustainable finance during the Slovenian presidency. The European Commission announced that the EU proposal on green bond standard and the renewed sustainable finance strategy will be published in July. I'm looking forward to these proposals. I believe that the renewed strategy will further clarify how the sustainable finance will help in supporting the transition to a sustainable and carbon neutral economy. However, the taxonomy will improve transparency for environment, social and governance factors that promote environmental characteristics or target environmentally sustainable investments. To get this right, it is important that we build a holistic and harmonized approach. We need to work towards the establishment of common standards for both non-financial sustainable reporting and taxonomy at the EU level. Namely, if Europe wants to become a climate neutral economy, it is essential that we prepare reforms and regulate the framework for sustainable finance. The Commission's Sustainable Finance Agenda will have a significant impact on green bond issuance. I do not expect any major surprises in green bond standards, as they will build on the work of the technical expert group on sustainable finance. The EU Green Bond Standard will improve the effectiveness, transparency, comparability, and credibility of the green bond market. I think that the further work on the bond standards is very welcome and that it will encourage the market participants to issue and invest in green bonds. Establishing harmonized and clear standards can, in my opinion, start a very positive chain reaction that results in projects and investments that contribute to overall well-being. And just as we cannot bypass sustainability in the financial area, we cannot bypass the digitalization. Recently, we witnessed an exponential growth and progress of digitalization. This progress is influencing the ways in which consumers use financial services. Technological advancement also influences business models of financial companies. I see many benefits in the development of new digital technologies and the novelties that they introduce. I believe that there are also many opportunities in crypto assets and their integration into financial markets. But while we absolutely must encourage digital development in the area of finance, we must be aware that new inventions can pose risks. At the same time, risks to financial stability and money laundering, and also risks to consumer protection, personal data protection, and cyber security. In order to gather all the potential that digitalization holds, we need to adequately address these risks that it poses. I also think that by regulating digital finance, we could increase consumer confidence in this type of investments. If I turn to the proposals that are currently on the table, I think it is important to establish regulation on market and crypto assets, distributed ledger technology, and retail payments. This is urgent because crypto assets are becoming more and more integrated into the payment system. They present a non-banking source of funding, while the distributed ledger technology supports fast and reliable payments. The regulatory framework should have a clear scope, be risk-based and future-proof against market developments, and ensure technical currency. I believe that Digital Operational Resilience Act will have a significant impact on the EU financial sector and is likely to set a global regulatory precedent. We need to consider the proposal carefully and ensure that it is safe, transparent, and effective in practice. The files are complex and the regulatory framework is new. These topics will be the priorities of the Slovenian presidency. Because of growing importance of the digital finance, these issues should be dealt with efficiently. But allow me to again emphasize that even though we want and need solutions quickly, this should not come at the cost of not being precise enough. Capital Market Union is a structural reform that Europe needs. But we have to keep in mind that the Capital Market Union cannot be built with a one-off package of measures. Building of the Capital Market Union is a process. I think that there is work ahead to reduce Europe's reliance on bank credit to finance the economy. Sustainable and digital finance is expected to contribute to transforming Europe's financial system and will offer investors a better choice. I also believe that Europe is at the point where it needs to establish itself as a leader in both green and digital agendas, because it is most likely that they will define the business models of the future. I believe that EU and euro area member states have the potential to create a successful European capital market, especially now with the upcoming EU-level regulatory changes, environmental, social and governance requirements, and the opportunities offered by the fintech solution. This is the reason why we strongly support the Commission's Capital Markets Union Action Plan. Above all, proportionality should be one of the key principles for countries with small markets and should apply horizontally to the financial services sector. I believe that it is very important that we do not forget about financial education and consumer protection. They should go hand in hand with greater participation of retail investors in the capital market. I'm convinced that we need more clarity on the current framework for the market participants and for the wider public. We should achieve more consistency between legislation, including consistent information to be provided by issuers. As part of the Capital Market Union Action Plan, we expect work on the legislative proposal for the establishment and operation of European Single Access Point for financial and non-financial information publicly disclosed by companies. The European Commission will also publish its long-awaited review of the Markets in Financial Instrument Directive, Markets in Financial Instruments Directive. The MiFIR proposal is anticipated for the fourth quarter of 2021. I expect the main solutions to be related to the transparency requirements for equities and post-trade requirements for bonds, the creation of consolidated tape to improve post-trade access, investor protection rules, and equity and derivatives trading. I support the idea that the changes to MiFIR should go in the direction of increasing market transparency and allowing for a more equal treatment for all market participants and all financial instruments while reducing transition costs. During our presidency, we will keep a close eye on data quality, as it is an important foundation for the success of the tape. The transparency of the market structure is of paramount importance, and we need to maintain a diverse and competitive trading landscape in Europe. But in this context, those ineffective and inefficient features of the European equity market need to be resolved. The upcoming review in Solvency II, which will start during the Slovenian presidency, is one of the most important files also for Slovenia. Solvency II has proved its value since its implementation in 2016, so any modification of the framework should therefore be evolutionary. The objective is to stimulate the long-term investments by ensuring investing to the real economy and to calibrate prudential capital requirement in the environment of low interest rates. To conclude with, I would like to say that I hope we will hold onto incentive of green, sustainable, social and digital. There are many possibilities at our disposal. Many of those can contribute to a better future for the generations to come. The EU is on a good way to become a global example in setting high environmental standards in the financial area and elsewhere. But we must not stop here. We must follow the novelties, face new challenges, and turn them into opportunities. We also adjust to the course of time with new regulations that will enable improvements and safety. Thank you very much for your attention, ladies and gentlemen.
Well, thank you very much, Mr. Šircelj. And I think if I listen to what you've been saying, it's a very ambitious agenda of priorities for the Slovenian presidency, and I only can wish you best of success and hope we will have the opportunity to meet in person in the fall, as you were saying in the beginning. I think if I look at everything that is up in the sustainable and the digital agenda, etc., that is, of course, a very, very important and vital, crucial point to define the strategy of the EU forward. So I think your presidency will be very, very important, I think, to ensure that, again, the future of Europe with a strategic outlook to I think a more sustainable and a more digital economy will come true. And I think what you said around Capital Markets Union and the MiFIR review is probably a perfect introduction to the next panel we're going to have, asking for, I think, more transparency on equities and bonds and a level playing field, as well as having a very close eye on data quality. We very much agree with that. We think this is paramount to, I think, really create a level playing field and ensure that data are available and are correct for all market participants. With that, thank you very much, Minister. And I would turn, thank you.
Thank you.
And I would turn over to our panel, which I basically have introduced. We're discussing competitive and efficient markets that deliver for issuers and investors. And we have Niels Raab, the chair of the FESE Management Committee and head of regulatory strategy for Deutsche Börse, who will moderate that panel. Niels, the floor is yours.
Thank you so much, Ryan, and a warm welcome also from my end to today's FESE Convention. And of course, Ryan already alluded to it. We have a very exciting panel discussion upcoming on an exciting theme in terms of ensuring competitive and efficient markets that really deliver to the needs of investors and issuers. I think with sluggish economic growth, a much needed COVID-19 recovery, pressure on public finances, pressure on monetary policy, probably a more sluggish European banking system than expected. I think we are all clear that the future of the European Union capital markets are going to be a very decisive and integral element for the future outlook of the European Union, as Ryan also just alluded to. I think if we look into the core proxies that we have, of course, seen across the global capital markets in terms of actual benchmarks, I think just to recap here firmly that we are all conscious that the EU capital markets are lagging a bit behind. If we look at 1-2 key proxies, give you the metrics on IPOs, we've seen 1,400 of those the last year. 60% of those went public in the United States or China. Only 7% of them came to the European Union. Also, I think if we look in terms of market cap, of course, we see the significant outperformance in other jurisdictions. Now, I could not be more delighted to introduce the distinguished panelists that I have brought with me today for a great stimulating debate that will hopefully shed also a bit more light on some of the core reflections around the future of market structure transparency and the famous European Commission proposal on the consolidated tape. Now, let me kindly kick off with this. To my virtual left, I'm extremely delighted to introduce Beatriz Alonso. Beatriz is not only heading the cash market and the market data business at BME Group, but is also a member of the ESMA Secondary Market Standing Committee, as well as an advisor to the CNMV in Spain. Importantly, Beatriz has already been involved in the MiFID I implementation and brings with her a very enriching knowledge into today's debate. Thank you once more, Beatriz, for taking the time. It's great to have you with us.
Good morning, and thank you.
To my virtual center right, I'm extremely delighted to welcome our honorable member of the European Parliament, Markus Ferber. Markus has, of course, been a member of the European Parliament since 1994 and has held various senior positions over the last 27 years. In that context, currently, he's, of course, the EPP coordinator for the Econ Committee. For me personally, more importantly, for today's discussion also, he is, of course, known as the parliamentarian Mr. MiFID. Thank you, Markus, for taking the time and for joining us here. It's great to have you with us.
Thank you very much for the invitation.
I'm equally delighted to introduce Tilman Lüder from the European Commission. Tilman has not only been holding a doctorate from the University of Tübingen, but he's also been with the European Commission since 1999. Over the past 22 years, he's held various key positions in that context, ranging from DG Combe over through to the spokesperson time with Commissioner Monti, and has also been working in DG Mark and DG FISMA realities, where he did not only had the copyright unit, but also did obviously the famous term as the head of unit on the asset management front before taking up the monumental task of running the securities markets unit. Tilman, thank you also to you big time for making it today and for joining the discussion.
Thanks, Niels.
Next in the lineup, I have Guillaume Prasch, Managing Director of Better Finance, the key European federation of investors and financial services users. Guillaume has been actively involved, of course, in many key high-level stakeholder groups, not only for the Commission's high-level forum on the CMU, but also covering the ESMA securities market stakeholder group, is also involved at the IOPA level in the insurance and reinsurance stakeholder group, and has previously in his career acted as CFO to what is nowadays Sanofi, before actually working as a managing director of the European affiliate of Vega Group from 2000 to 2006. Also, very warm welcome to you, Guillaume. Thank you for joining us in this session.
Thank you.
And last but definitely not least, let me quickly introduce Stéphane Giordano from the French Financial Markets Association. Stéphane joined Société Générale in 1996, head of the cash equity execution teams for Europe between 2008 and 2013, and has joined afterwards the public affairs team. Also a very big thank you, Stéphane, to you to make it today and to join and enrich this discussion from a broader financial markets perspective. Now, let us jump straight into the debate. And Tilman, as representative of the European Commission with an exclusive right of legislative initiative, I will turn to you first with a challenging task of sketching a bit the current reflection on how the EU's market structure has evolved, what the current state of affairs is, and how we best deliver on a framework that really manages to guarantee the interests of issuers and investors. What are your views on how the EU is currently doing in that regard? What is sort of your perspective on how we can unlock more potential from the markets to boost the growth across Europe? And what are sort of your personal reflections on the way ahead?
Thanks a lot, Niels, and I will be very succinct in setting the scene because I think we should have a good discussion. So I think our starting point is that we have introduced a very, very almost hyper-competitive market structure. I think we've heard this morning, again, references to the hundreds of different execution venues that currently populate the European trading landscape. And that is true for all the asset classes that are part of the MiFIR family. That is true for equities, that is true for bonds, and that is also increasingly true for derivatives. There are lots and lots of execution platforms. The market is hyper competitive, which was the intention. So this is perfectly working to plan. I think what was slightly less considered and what was slightly less in the foreground of the attention of the legislators was that all of this competition leads to extremely high search costs. This is very difficult to navigate all these competitive markets. It's very difficult for an investor, an average investor, a retail investor to get a view what's happening at any given point in the day, at any given market. Where can I buy the best possible price? Where can I sell? Where can I get the deepest pool of liquidity when I have a larger order? These are all things which have become extremely complex, and it's a bit, I like the supermarket analogy, and we're going to go to retail and wholesale analogies, I'm sure, throughout this panel, but it's a bit like only knowing what Deleuze has and having no picture on what's on Carrefour and on the other big shops, because you cannot afford to look at all the data. The data is expensive. And I think we have identified three main issues that we wish to tackle with this MiFIR reform. One is the information asymmetry. Not everybody sees the entire market. Not everybody has a full view of prices in all the different supermarkets, if you like, all the different trading venues, the big supermarkets, the medium-sized shops, the little grocery shops. It's basically reflective of how our trading landscape across asset classes is organized as well. You have the mega markets. These are the exchanges. These are our hosts today. So you're the like big mega markets with the huge parking lots in the front, and everybody goes there. And then you have the more specialist supermarkets. They don't carry the full range, and they're not also necessarily an admissions or listing venue, but sometimes the price is pretty good there, and sometimes they offer the liquidity to execute. And that is the information asymmetry problem that we have identified. I've already mentioned search costs. For your average investor, it's obviously often very difficult to find your way around this myriad and extremely competitive structure. And that leads to the issue which is very close to our heart, which is the best execution practices. If you don't see the full market, you don't know whether you got a good deal. And I think we need to really work on best execution. We need to show retail investors that their brokers did actually procure the best possible deal under the circumstances. And that's the nucleus for the tape, and I won't go into the tape because I'm sure we will have opportunity to do so. But the basic idea behind the tape is exactly that. It is to show everybody where best execution is available throughout a trading day, where the best prices are, where the tightest spreads are, and of course also where the deepest pool of liquidity resides, because that's what you need to know if you want to make a good deal, if you want to be a successful investor. And the overall game here is to make the European Union more attractive, because it is complicated how we have set up our system, and it is complex, and it is confusing for a lot of people. And a lot of people just don't participate in the capital markets because it's so difficult to understand how they function. And in that sense, yes, we have to take responsibility. We have not made it easy. We have made it very competitive how these markets function, but we have not made it necessarily easy to understand. And I think that is the aim here also of the MiFIR review, apart from all the technical considerations about data consolidation and making it more accessible to everyone. We want more people to participate in the capital market. We want more retail investors to take an interest in how capital markets work. We like online brokerage as long as it's fair and as long as an online broker guarantees best execution. But finally, we also realize Europe is not an island. We want also participants from other jurisdictions to come to Europe and to want to trade, to want to list, and to want to invest in the European Union. And it's also part of our agenda to make Europe internationally more attractive so that more people, not just within the Union, but also from outside the Union, decide that this is a really cool place to trade. This is a really good jurisdiction to trade. It's fair, it's transparent, you get good prices, and you will get a decent return if you invest in the European Union. And that's the overarching goal, making the European Union more attractive as a capital market for not just retail, but also international participation. Thanks a lot.
Thank you very much, Tilman, for setting the scene there and outlining so many important issues. Markus, if I may turn to you as an elected representative of the European people, and I see that you carry that symbolism with proud and a European flag in the background. But how do you look at these issues? To Tilman's analogy, have we created too many supermarkets? Have we gotten the balance right there? What's sort of your broader perspective when you try to find the best price of the milk on your shop on the corner?
Yeah, thank you very much, Niels. It's always good that the Commission is setting the scenes, and we as parliamentarians have the honor to follow that. Honestly, I use this picture in a lot of areas as well. When we speak about taxonomy, which was mentioned by Minister as well, I use a similar picture in the supermarket where you have the buyer products and you have other products, and that's for me taxonomy. But honestly, we should start that our systems have been proven very stable during all the crises we had. So we never had during the COVID pandemic any financial crisis symptoms, and that shows firstly that all structures or all markets, I will not use the word supermarkets, but all markets have worked properly. And that is really a good lesson we learned. So what we did in the past as regulators is well functioning. And I think that is a good starting point for that. Of course, regulated markets have played a big part in that. And we have seen that in times of high uncertainty, more trading volume goes to regulated markets as a safe, transparent and robust trading venue where core price formation takes place and where there is liquidity. Of course, there are other markets as well, but that is one of the lessons we learned as well. And there's another lesson to be learned from the crisis. So we cannot build a company on debt alone. And those companies with high debt levels and little equity have suffered the most. And that is something we have to take into account as well. And to restore resilience, building or rebuilding equity buffers will be key for the long-term success of European companies. And that is something we have to take into account as well, as those who had buffers have emptied them as well during the time, and they have to be refilled. So while one could conclude that the EU market infrastructure has weathered the storm, unfortunately not all is perfect with European markets, and that's the other story. The past years have shown that our market structure has some shortcomings. And the upcoming review of MiFIR, and in early 22 MiFID, will be an opportunity to remedy some of those problems that have become apparent with the implementation of MiFID II. I'm thinking in particular of the growth in off-exchange trading and the growing number of systemic internalizers. I do not know which classification of supermarkets they are fulfilling, that do not help the price formation process. As a result, and contrary to our intentions as legislators in MiFID II, the share of price-forming lit trading activity has decreased to the detriment of issuers and investors alike. So I think we need to think hard about which elements of the current market structure we need to retain and how we can increase or decrease the relative attractiveness of the venues in order to achieve the outcome we had initially hoped for and which I was working for. One possible avenue would be to restrict SI's equity trading to above the larger scale threshold. Such a move would incentivize lit trading and ensure the quality and robustness of price formation in line with our initial objectives, which we had in MiFID II negotiations. In this simplified market structure, the larger scale threshold would be used as the main tool to delineate lit and dark trading. That would also mean that there's little need for a double volume cap mechanism, that does not work particularly well anyway. So I missed this phrase in the supermarket picture, but I think Tilman is agreeing that this double volume cap is something we have to look into. What I was proposing now would not need a double volume cap anymore. Perhaps, as we will also be addressing the issue of market data, that was mentioned as well in this picture. Do we have a fair price for the data availability to use all the infrastructures? I would also like to briefly comment on the issue of the consolidated tape, which Niels, you have introduced in your introductory remark as well, which is seen by some people as a silver bullet to fix all that what is wrong in the European markets. I'm more skeptical about that. The idea of a consolidated tape is arguably to get the full picture of what is going on. It would be useful. It would be a useful supervisory tool and probably also a good instrument for checking best execution, which is one of the threats in a more and more digitalized trading world as well. And there's one precondition, so the data quality. The consolidated tape will only be as good as the worst data that is fed into it. That's a very easy thing to understand. Right now, the data quality coming from venues other than regulated markets is often extremely questionable. So the first and perhaps most important step towards consolidated tape would be getting data quality for all venues up to a certain standard. Once we have achieved that, then we can talk about a sensible consolidation of the data might look like. A tape of records for equities that gives the full picture to both regulators and market participants at the market's closing could be a sensible first step. And this would be my main points for the priority now for the upcoming MiFIR review, and I'm happy to discuss even other things in detail with all of you. Thank you very much.
Great. Thank you very much, Markus. Guillaume, if I may pull you into the debate also from a, say, more retail and investor perspective. I think Tilman and Markus have touched already on some of the core themes, but how do you assess the situation at the moment? To Tilman's point, has it become too complex? Are we seeing a market reality where investors get lost and don't kind of find through the jungle anymore?
Yes, thank you very much, Niels, and thank you for inviting a representative of EU citizens who are still, despite everything, trying to access European capital markets directly. I am not a technical expert of capital market structure. In fact, I should not be. When you own a car, you are not expected to know the technicalities, of what is under the hood. But market structures, as you say, Niels, as you seem to say, should be transparent and simple enough for the real economy users, which is the issuers on one side, especially SMEs, and the investors. And they should ensure market integrity towards these real economy users, in particularly the smaller ones. So I want to concentrate on what we need for the real economy. It's not only a question for financial intermediaries. And I'd like to remind everyone two facts. First, since the 1960s, EU citizens owned at that time directly about 40% of the EU listed economy. Nowadays, it's about 10%. Since the CMU start in 2015, direct listed bond holdings by non-professional individual investors, what you call retail investors, have collapsed by 38% in the whole EU to 2% only of their financial savings. And stock holdings, direct stock holdings, listed stock holdings have stagnated in value to 4% only of their overall financial savings, and this despite the massive increase in stock price over these 4 years, and despite the CMU 1.0 that was started in 2015 with one of its primary goals to foster retail investments into capital markets. So obviously it has not worked up to now. And this is not good for you citizens because most intermediate package investment products are far from delivering the capital market returns to long-term and pension savers, and even often provide negative long-term real returns. It's not good, of course, as well to SMEs, investment, innovation, and growth. But too many, and that's my second general point, too many policymakers do not seem too concerned about this. Actually, they hardly mention this anywhere, and I see two reasons. Sometimes they may be confusing capital market investments with anything that is not bank savings and deposits, so like life insurance and pension savings. However, they are very packaged, very complex intermediated products. But I think there is a more worrying explanation. Just let me tell you my personal experience. When I was hired as an expert in 2009 for the predecessor of ESMA called CESA, I was rightly included by CESA in the market participants category of stakeholders. Now I'm a member of the ESMA stakeholder group, and I have been kicked out of the market participants category and included in the consumer category. If you want further evidence of the treatment sometimes by policymakers, not Tillman, of course. I was very happy to hear that he is all for increasing retail participation to capital markets. But look at how MiFID II is disincentivizing intermediaries such as banks to promote direct investments into a listed portfolio to their retail clients. Just ask them. Also, when you look at the reactions to the recent GameStop scandal, which is, by the way, not a US only, as I often hear or read, but also an EU scandal. Look into what happened in Germany with GameStop. Instead of pointing to the complexity, to the opacity, and the conflicts of interest of the way retail order flows are being handled, some point to these foolish individual investors who should not play in the adult's yard and go back to the schoolyard, sticking to these intermediated, complex, fee-laden package products, thus wanting to leave equity markets entirely in the hands of professionals. But when you say professionals, you have to look at what is the reality. The reality that's mostly purely financial intermediaries, now more and more not even based in the EU, and who are mostly dealing with other people's money, your money, my money, EU citizens' money. I'm still very hopeful with the MiFIR review, which we are going to discuss right now, the CMU relaunch, the retail investment strategy that is being announced for next year, the sustainable finance, which is a prerequisite success factor, because we really need long-term engagement of investors, and also Commissioner McGuinness' statement that she will place retail investors at the heart of our policy. Last word, Niels, this is not only the interest of EU citizens as long-term and pension savers and of SMEs and economic growth. It is also for the very sustainability of capitalism. Because if we continue to crowd out citizens from capital markets in favor of these financial intermediaries I was talking about, what Professor John Kay calls other people's money, or in the UK it's also called agency owners, it will not last long. We need at last a sustainable corporate governance. Thank you.
Thank you very much, Guillaume, for these very important points. And it sounds rather alarming based on that empirical overview. But Stefan, if I may ask you to comment on this from a broader sort of French Financial Markets Association perspective also. How do you judge some of these issues?
Well, first, I think we all agree that we need to have markets that are attractive for all participants, including retail participants. And for that, we need to ensure that we have sufficient transparency and that the price formation process is robust enough. And on that point, that very point, I would like to insist that I fully agree with what Markus Ferber said earlier, the price formation process worked during the financial crisis, and it's really important to keep that in mind. We may make it better. We may bring maybe more transparency in some segments of the market, but it's important to keep in mind that it does work as is. When it comes to transparency, we may bring more transparency into the market, but it's important to have in mind first that for each financial instrument, there is a balance between transparency and liquidity. And if we bring more transparency, we need to make sure that we do not damage liquidity. And that's specifically true, obviously, for non-equity instruments, especially bonds, for instance, but that's also true for equity. The second point is it's fine to have more transparency, but we also need to make sure that market data is reliable, is accessible, and is affordable. And that's why most of AMAFI members, for instance, do strongly support the creation of consolidated tapes, including on equities, that will make it possible for everyone in the market, including retail participants, to know what's happening, to know where liquidity sits, and at what price they can invest or disinvest on a specific share and later on a specific bond. So it's really something to me that is critical. And I do not believe that there is an issue currently in market structure or on transparency, but I do believe that there are factors of fragility for the price formation process. But to me, for instance, the strong share of passive investment and the strong share of trading that occurs during end of the auctions, for instance, is a factor of fragility for the price formation process, and that's something I think we should also question. We probably should ensure that we have a sufficient wide panel of solutions for retail investors, from direct investment to packaged products, including passive investments, but we should not push retail investors only on passive investments, for instance.
Thank you very much for that outline, Stefan. Beatrice, if I may ask you more from a, say, exchange perspective, also I think reflecting on the points that we've heard from the other four panelists, seems like we've come a long way, especially also since MiFID I. I alluded to the fact that you were already doing the implementation back then. You seem to have survived it, or is that a wrong interpretation on my end? Do you think it has been a long way into the wrong direction, into the right direction? What are your personal reflections there?
Thank you, Niels. And it gives me, being the last, it gives me the opportunity to comment on some of the points, or to complete some of the points I had already in my mind. So first thing, I would say that MiFID II has not achieved its objective of bringing more transparency or reinforcing the price formation process. And I agree with Tillman that it's maybe too much complex. So a simplification of some of the concepts will for sure bring further leveling the playing field, will reduce fragmentation, and will do our markets more efficient. In second point, I think we need to review how we understand and we define liquidity. Maybe in here a little bit technical, but I think that the main factors in assessing or computing liquidity are still the spread, but also very important the depth of liquidity that is related to this spread. I think we need to measure liquidity quality. We have to achieve that will allow us to achieve best execution. And for that, we need to have robust liquidity mechanisms that are mainly based on morely trading and more contribution to a price formation. I very welcome the comment by Marcus on the relevant role that the regulated markets have played, especially during the COVID. We have been resilient, that we are bringing this price formation and this liquidity under the best conditions possible. And third point, do not want to forget is that sometimes we lose or we forget the essence of the markets, that is serving on one hand the issuers and on the other hand the investors. So we have to be sure that we are attracting more companies to the markets related and in connection with the CMU. We have to be as well sure that we have a diversity of investors. We do not want to have only institutional investors. It's very important, it has already been mentioned as well, that we need to have retail investors on board. And in this, the special focus should be, again, on these retail investors. We have to be sure that they have a direct access to the market in the best conditions of investor protection of course, and we have to pay special attention as well to the SMEs companies that will have to need some help, and it's already been provided to these companies. And finally, on the consolidated tape, I'm sure we will have a further debate on this, but I think there are two main points. The data quality, it's very relevant to achieve the best solution or the best possible solution. And as well, we will have to have the full picture. Everybody has to contribute, all the different stakeholders have to contribute to this information. Thank you very much.
Thank you, Beatrice. I mean, I've heard a lot of notions now through, I think, consistently all of your interventions around that broader notion also of what may be referred to as transparency or non-transparency. Let us dive slightly deeper into that topic. I think also because, of course, there's been a lot of attention around that conversation the last days with, I think, a couple of market participants questioning a bit the ESMA findings that have been published also as part of its market structure report. Just for reiteration purposes, ESMA found that only about 53% of all the volumes occur on regulated markets and MTFs, while 26% remain in OTC and 21% with SIs. I think ESMA has also highlighted in those findings that the total volumes that are not pre-trade transparent have actually increased from about 22% in January 18 to about 38% in December 19. Tilman, how do you see this? Do we need to sort of reconsider an intended simplification of the market structure? Do we have it wrong? Should this be refined further in technicalities? Should we rather get prepared for, say, MiFID III and another 25,000 pages? Or would your reflection rather be into probably somewhat, say, in an intermediate step? So over to you. How do you see some of these findings and reflections?
I think my main comment on this is that, as Stefan rightly pointed out, we should be trading throughout the day. We should not be trading just in a 5-minute window at the end of the day. That is a very scary phenomenon. There is not enough trading activity throughout the trading day. And we need to figure out why this is. And my analysis, because the impact assessment and our preparatory materials haven't yet been endorsed by my institution, so I can only talk for myself and the team and what we have found in talking to many, many people. And by the way, I'm extremely proud that my team, we are in the lead in FISMA in terms of having consulted the most stakeholders ever. We have a system where this is recorded, and I think we account for, I will not tell you, but we account for a huge percentage of the overall stakeholder consultations, notably because we have been taking the MiFID and the MiFIR reform so seriously, and we've spoken to so many people about it. And I think this phenomenon that there isn't a lot of trading activity in the entire trading day is concerning, because why do we have stock exchanges which are open throughout the day? If everybody just looks at the opening price, then they take they trade a bit in the morning, nothing really happens. Then they go for lunch, they doze off, they come back shortly in the afternoon to confirm that nothing has really happened, and then they all put their passive orders, as Stefan rightly said, into the closing auction. But it's pretty damn easy to be an asset manager if all you have to do is to slightly monitor a bit the intraday activity and then chuck all of your stuff into the closing auction, because nobody will accuse you of not having obtained best execution. But on the other hand, you also didn't try very much, because you didn't actually take the opportunity to trade throughout the day. And we think that this lack of activity throughout the trading day is due to the fact that this is very difficult to navigate the markets, and it's very difficult to find those pockets of liquidity, to find the best prices. And that's why we are convinced that an intraday tape is necessary. And that's maybe the one thing where I would want to have a bit of more in-depth discussion with Marcus as we approach this, because Marcus mentioned that it would be really good to have an end-of-day tape of record. And I think we already have T+1 tapes. We have tapes of record. What we are trying to maybe think about is to have this intraday tape, because the trading days are so calm, because there is so little activity and there is so little interest. And I think this is the main factor of fragility which we do want to address with this tape. I think the MiFID system, let's not be too pessimistic about it. I think in a global competition, and I salute the European Parliament and the co-legislators for this, in a global competition, we actually have one of the best systems. We just have this fragmentation issue, which is a classical issue for the European Union, that everybody has a stock exchange, and this is perfectly fine, and then there are the alternative venues, and there is this proliferation of venues. But we actually have achieved quite a lot with MiFID. Let's not be too pessimistic, or let's not be too negative. What we now need to do is to consolidate, to have throughout the trading day a view of what's happening, so that people, when they are questioned about their best execution, they actually have to prove, why didn't you trade throughout the day? I can see on my tape that at this particular point, precisely time-stamped, this huge pool of liquidity in this particular share was available. Why did you not tap into this? Why did you just sit around, twiddle your thumbs, and wait until the end of the day and participate in the closing auction, where you got a slightly worse execution price? I think the retail people need to see this, the smaller investors need to see this, the smaller fund managers need to see this, and then you can query your financial intermediaries, you can query your broker. Why were you passive throughout the day? Why did you not participate in the liquidity? So it's great to have stock exchanges, and we absolutely think that they have a crucial role to play, but people are underusing them. They're using them as a listing venue, and that is the main, of course, function of a stock exchange, to offer both the initial public offering and the subsequent trading. So people are using it as a listing venue. I'm sure we could have more, and I'm sure that CMU will work more, but people are making an imperfect use of an exchange as a secondary trading venue. And let me conclude with an example. It is not just about consolidating the information on particular blue chips, which may be traded on the principal exchange and then also be traded on some of the alternative execution platforms. Most people look at this consolidated tape as an exercise in trying to reconsolidate all this fragmented trading which happens in the blue chips. That's not the full story, and that's potentially also maybe not the main story. The main story here is that lots of investors would like to invest in smaller issuers, would like to invest on regional exchanges, but the information is not available in a single tape. If you want to invest in Eastern Europe, you will have to piece together this information from lots and lots of different data streams. There is no single place where you can see what is trading across the European Union on the smaller exchanges, on the regional exchanges. So don't forget that this consolidated tape is not just to give you the full picture of blue chips and where they are traded. This is also a means to get all of the smaller issuers, all on the regional exchanges, visible for everyone, because not everyone will subscribe to data streams from all the 27 regional exchanges across the European Union. But if it's shown in a single tape, people will see these opportunities and people will act on it. So we are trying, in summary,
to make also regional exchanges more important as an investment destination. And we are trying to give people the full picture across our exchanges in a single portal. Thanks.
Thank you, Tilman. And you did mention the important point of wanting people to trade on exchanges throughout the day. So I think we will happily re-invite you to one of our upcoming FESE panels. But kidding aside, it seems to me intellectually as if that discussion also seems to have resolved, at least partially, the discussion we saw around shortening of trading hours. But that may be a different subject then. Markus, if I may kindly turn to you on this broader perceived need for a consolidated tape. I mean, you mentioned in the beginning that you were a bit more skeptical and didn't kind of see it as a silver bullet to sort of quote unquote take what you said there. But if I listen to Tilman, how do you see this project evolving? What's the sort of right balance we need to find there between, say, the primary markets that are sort of symbolic of the price formation process and integral reference prices versus the what I call personally alternatives that can then limit sort of other market impacts in terms of information leakage and so forth. But what do you think is the sort of way ahead there?
Yeah, thank you very much, Niels, and thanks, Tilman, for these insights, as we as parliamentarians don't have these technical tools to invite so many stakeholders. As long as I'm not the rapporteur, I don't have to publish it, but honestly, of course, we will wait what the Commission is proposing, and of course we will read carefully the impact assessment, as that was one of the remarks from other political groups during the debate of the mini review, that no proper impact assessment was done. So any further detailed information about possibilities is well received on our side, from the European Parliament side. As I couldn't agree more what has been said by Guillaume from Better Finance, that we should more attract private investors to go to capital markets. But then we have to wait for the MiFID review, where we have all these consumer protection issues, which are a high burden for especially small banks who have the majority of the clients. If I look to the German picture, it's not the large banks who have the clients, it's the small banks who have the clients, the private investors, and we should reduce their bureaucratic burden to attract private investors to the capital markets. But that's another story beyond that, but I wanted to address that, and I'm not so pessimistic as Beatrice was in her remarks. Of course, as you said, I'm the Mr. MiFID. Of course, I'm protecting my baby a little bit, but honestly, it's not as bad as it was described, this baby, and it's growing quite well. But we have to give them now the teaching for a teenager to bring some problems we have identified out of the scope. And honestly, as we are challenged by new issues, you know, the question of GameStop was mentioned, forgotten by whom, I think it was Stefan, where we have a fully new business model where best execution is not in the center anymore, only reducing costs. But what does it mean for me as an investor? Do I really get best execution when I have only a payment for order flows? That is a question which we have to address as well. Otherwise, best execution is a wonderful frame without any content anymore. And therefore, if consolidated tape, even more than as I have proposed it, is a solution, I'm open to that. But we have to address these new challenges as well. Otherwise, we will fail again. So we do not only have to identify the problems of the past of MiFID II and to close these gaps, like I have mentioned, others have mentioned, these growing parts of SIs, but on the other hand, we have to look to the real challenges which are coming from the digital world, where I have doubts that consumer protection is safeguarded, best execution is safeguarded, and all informations available are really integrated in a proper form. So therefore, there are huge challenges in front of us we have to address as well. So MiFIR will be an important step in the proposals from the Commission, and I can only say that from Parliament side we are open for this issue, although it looks more technical. It's very, very important. It's more than technique. And of course, the second step then will be done next year when we get the MiFID proposals, how we really can attract private investors to the capital markets, to protect them on the one hand, but to give them a chance as well to have access. And if access is only granted via channels where all these problems occur, which have been mentioned by Tillman with all his experience, then I think we will not attract private investors to the capital markets because they will not feel being dealt properly. So there are a lot of issues to address. We are open, as I said, and with a proper impact assessment, I'm open to more. But the lesson I learned from MiFID II is everyone speaks about consolidated tape, no one takes part in the solution. And we asked, if you look to MiFID II, we asked business to find a solution. Did not work properly. We asked legislators to find a solution. We are progressing, and hopefully we get some proposals, and we can address this issue now. But it's 7 years after we finally negotiated MiFID II, which was in January 2014 when we closed the file politically. It went some time till it came into force, but that was the end of the trilogues between Council and Parliament. So 7 years ago, and we have had no progress in these 7 years on this issue. So everyone is asking for it, but no one is taking initiative. And that brings it back to the table of legislators to deal with it, as markets are not able or have not been able to find an answer. And at the end of the day, and that is the big question or the white elephant in the room, who is going to pay for it? And that is something which has to be addressed as well. Those who ask for it at the end of the day will have to pay for it as well.
Thank you very much, Markus. And I would like to turn, Guillaume, to you to enrich this a bit from a investor retail perspective. Also, I have a question from the audience here by Jack Schickler, who has asked that ESMA told today market data providers to tie costs to prices, and if this was sufficient to address problems in the market. What's your sort of broader perspective on the maybe on the one hand side issue of data availability, accessibility, and maybe also in light of the Commission's future reflections on a retail strategy, the point that Jack Schickler has made here around the costs of market data. So maybe over to you. How do you see this? And from a broader costs perspective, what's your sort of take there?
Yes, thank you, Niels. On the data access, we published a report 2 months ago on the access to data for retail investors, for non-professional investors. And I was very happy to hear Markus Ferber say that we have to improve data quality as a precondition for any consolidated tape, as the data quality of other than lit venues is, and I'm quoting him, Markus, highly questionable. This is exactly the findings of our research report, where de facto we have no market data access to from the dark venues, and even from the venues that are not the traditional lit market, it is highly problematic. On the retail strategy, maybe it's also the opportunity to talk about this point of the consolidated tape. To answer also, of course, Markus Ferber is right saying that a lot of retail investors' issues will be and should be addressed in the MiFID review, which hopefully will happen next year after this retail strategy. But I was also very happy to hear again from Marcus that there should be some prerequisites to the consolidated tape. And I would like to stress how much they impact, and they are important for retail investors who are investing directly in capital markets. We de facto, until 2007, we did enjoy a consolidated tape for free and easily accessible because 70% of trades were lit. Today, it's less than half. In fact, our statistics show that it's even less because, as I said, some supposedly lit venues, new market operators, it's not so lit for us. So I fully agree and support with Marcus Ferber that there are very urgent problems to fix before entering into a process of a consolidated tape, which will, I'm afraid, will divert a lot of resources, efforts, time of the Commission. The first one, as Marcus said, is the fastly expanding share of dark and so-called internalized trading. As I said, I am not a technician of market structures. I don't know if increasing the threshold of large-scale transaction is the solution. Since 2015, we are asking that SIs and the other dark venues be prohibited from dealing directly or indirectly with retail trades unless they come at par with lit markets in terms of transparency of market data. And I'm talking about post-trade, but also pre-trade. In the second issue is that the lack of easy and free access to market data is not only for individual investors. Now I see, for example, on payment for order flow, we say in French, the king is naked. In the US, they perfectly know how much is paid by whom, to whom is receiving it. For example, Citadel, how much they paid to Robinhood to get the retail order flows on GameStop, which are so valuable for hedge funds and for high-frequency traders. Also now, I think it was alluded to, we have finally gotten ESMA statistical book where we see the new landscape for equity trades, but now we are being told it's false. One of the key new market leaders wrote to us to say, no, but ESMA data are false. So also regulators, of course, and first regulators should see clear this. It's also a prerequisite, in my view, to consolidated tape. Lastly, payment for order flow, which shows, and it's not me saying it, it's the commissioner herself, it shows, it smells a lot like inducements and conflicts of interest, which are certainly impacting best execution, must be fixed now. And this is MiFIR review. This is not MiFID review. Lastly, on consolidated tape, and I'm finishing on this, Niels, we are afraid, we are concerned, like Marcus Weber, that there are things to be fixed before. But if the consolidated tapes would be still the main response from the EU authorities, then we see three prerequisites and three absolute priorities. The first one is start with bonds, because the bond market is much, much worse in terms of transparency. We have been kicked out of the bond market. We need the bond market when we have negative real interest rates on our bank savings. We should be able to easily buy and sell sovereign straight bonds or straight corporate bonds. We cannot anymore. I give you the statistics. We are totally being, it would take too long to explain why, but we are totally being kicked out of the bond market. So one, start with bonds, not with equity. Second, make the consolidated tape work for people. Unlike in the US. In the US, which the consolidated tapes has been existing for many years, it is not, de facto, it is not accessible to directly to retail investors. So you will be back to square one and we will have not sold anything for retail investors. Second and thirdly, of course, if there is a consolidated tape, it has to be governed by independent EU public authorities, certainly not by the financial industry. Thank you.
Thank you, Guillaume. And I also bring in Stefan on this point. And David Wright has kindly asked the question who should be also the provider of a consolidated tape? Maybe Stefan, you can pick that one, given that you're a strong supporter of it. Should it be a public institution, as Guillaume has just said? Should it be the exchange world? Should it be a competitive market? What's your view on this? And maybe you can also enrich that a bit with your perspective as to how the tape should ultimately be designed beyond the question of who is the provider.
Yes. On the consolidated tape, AMAFI recently released a paper providing some advice, some recommendations on the way it should work and should be governed. Most of AMAFI members believe that we need to have a consolidated tape that would be a real-time consolidated tape. Contrary to Guillaume, we believe that we should start with equities as proof of concept, indeed, and then have it to be developed on bonds. With regards to the consolidated tape, one very significant issue is who should pay for that, and what should be the cost of a consolidated tape. And again, on that, we need to make the equation work, and most of our members believe that the only way to make the equation work is to ensure that the provision of data to the consolidated tape is mandatory and is free of charge by venues, by APAs, by systematic internalizers. And with regard to the economic model, so how does the consolidated tape pays for its costs? We believe that probably the only way to deal with that would be to have a mandatory subscription by a sufficient number of financial intermediaries and members of financial markets. We believe that under that frame, the cost for any individual entity could remain quite low and would still make it possible to run an effective consolidated tape on the pan-European scope. With regard to governance, we believe it would be supervised directly by ESMA, but we do not believe that it should be run by public authorities. We believe that it should be based on technological skills that are already available, already exist within the industry. The main thing being that it needs to be governed on the ground of common interest.
Thank you very much, Stefan. Very clear. Beatrice, you will now have the challenging task of being the last one ahead of the keynote that we are already eating up time of. But so to wrap up also a bit with this very important conversation, but what's your take on the consolidated tape? Who should be the provider? And also, what are your sort of views on the main aspects and factors it should be composed of?
Thank you. On the maybe some comment on the real time. I was wondering if it makes sense to have a consolidated tape in real time that is for pre-trade transparency or pre-trade. Maybe it brings some questions about the latency and so on. I don't want to get some technical, so maybe it has more sense if it's post-trade. Bear in mind that for some, most of the exchanges have already some kind of free information with a 15 minutes delay. Maybe it's not the best solution, but it's something and it's not consolidated. But maybe it makes more sense for even for retail investors to have this post-trade. On the governance and the administration of the trade, I think we have to have a combination of stakeholders, not only the providers, not only the users. They have to be a combination there. And I think that I agree that ESMA should be in charge of the enforcement and the governance of this solution we may find as let's say, as a neutral body on the functioning of this tape.
Thank you so much. And with that, I would like to close the debate today, despite the fact that I'm sure that we could have kept on discussing this for hours, days, and weeks. A very, very big thank you once more to our distinguished panelists, Beatrice Alonso, Stefan Giordano, Guillaume Prasch, Tilman Lüder, and Markus Ferber from the European Parliament. Extremely delighted to have you all here. Fantastic discussion. Thank you so much. And with that, I will happily hand back over to Rainer, who will take you from here and hand over to the keynote. Rainer.
Thank you.
Thank you very much.
Okay, sorry, I think I was on mute. So, no, thank you to the panel, and thank you. I just said a lot of very important issues that were in trust transparency, payment for order flow, market structure and data, the consolidated tape. And I think overall we need to make sure that trust, integrity, fairness, and resilience are being preserved. And I personally liked very much the statement from Markus Ferber that best execution shouldn't be a wonderful frame without content. I think that is probably the biggest challenge we will face in this MiFIR review, to see that market structure and a consolidated tape actually deliver for end investors, and that it's not just a frame that we put up there. So that brings me to our last speaker for the morning, and I'm very happy to bring Kirstina Combe, Managing Director of LME, to the floor. Kirstina, please, floor is yours.
Thanks very much, Rainer. And thank you for giving me the opportunity to address you all today. I suppose under normal circumstances, we'd be making jokes about me being all that stands between you and the buffet, but I guess in today's new normal, most of you will be watching this from your home office with your slippers on and your coffee by your side. So without further ado, I think over the last 20 years, financial markets have seen strong growth and innovation, and derivatives have contributed substantially to this impressive development. Today, exchange-traded derivative markets are a key element of the global financial system, enabling businesses around the world to hedge their risk effectively and to invest and complement the growth of capital markets. We are, in essence, the backbone of global finance. We help our customers help their customers. We facilitate the funding of growth. We underpin the resilience of markets. We are, in essence, the connectors. The London Metal Exchange is a small part of this ecosystem. We operate the World Centre for Industrial Metals Trading and Price Risk Management. The prices discovered on the LME's trading platforms are used as the global reference price. The metal and investment communities around the world use the LME and LME Clear to transfer and take on risk 24 hours a day. The LME provides producers and consumers of metal not only with a physical market of last resort, but also with the ability to protect against the risk of rising and falling global metal prices. As a whole, ETD markets are essential for financial stability. Hedging offers a reliable risk management tool against shocks, as proved during the recent COVID-19 crisis. In the worst financial crises, deeply integrated and liquid ETD markets act as a refuge where prices can still be found and markets can continue operating. If the reliability of ETD prices is undermined, there is a knock-on effect on instruments such as OTC derivatives and the wider economy. ETD markets are vibrant. They offer product innovation, both in regional products and in internationally active markets. And through centralized trading and diversified CCP clearing, avoid excessive risk concentration, and optimize price formation. These characteristics are even more important within the context of a sustainable economic recovery from the COVID-19 pandemic and to address the uncertain future relationship between the UK and the EU. The coronavirus pandemic has taught us many things, but as we sat and continue to sit in our respective bubbles of isolation around the world, one key takeaway from me is we all benefit from being better connected no matter where we are based. The EU's current political reflections on key initiatives such as the future of the Capital Markets Union or the international role of the euro are symbols of the need to have fully operational, stable and independent market infrastructure to support, through their capital raising and risk management functions, the financing of EU economies. The European Commission recently announced ambitious goals in the Green Deal for Europe, which can be supported by exchanges and the launch of ESG derivatives. In recognition of the huge importance placed on the ESG agenda globally, in 2019, the LME announced its responsible sourcing requirements, applicable to all listed metal brands, embedding responsible sourcing as a quality requirement in its contracts and ensuring that responsibly sourced metals become the benchmark for the metals traded in its market. In 2020, the LME announced its sustainability strategy, which hinges on providing metal market participants with the option for greater transparency and access in respect of all sustainably produced metal, and metal that itself plays a significant role in global decarbonization and the circular economy. We recognize that we can all play our part. It is essential for Europe to enable and support globally integrated ETD markets and avoid policies which might destabilize them. For instance, the non-discriminatory access provisions for ETDs under MiFIR constitute a serious risk to EU financial stability and competitiveness, as they undermine the ability of market infrastructures to ensure transparent and orderly trading, liquidity and clearing when applied to ETDs. We all very much welcomed ESMA's no action letter and the delay of the entry into force of the MiFIR provisions by an additional year until the 4th of July 2021. In respect of ETDs, which was included as part of the finalization of the CCP Recovery and Resolution dossier in order to preserve financial stability in the Union. This temporary relief, however, will soon elapse and will not solve the inherent level 1 risk that the provisions will create if applied in July 21. An additional extension to the exemption should be adopted to allow for a thorough consideration of the level 1 framework, particularly on the relevance of maintaining the scope on ETDs. In our view, in the upcoming review of the MiFIR framework, ETD should be removed from the non-discriminatory access provisions. In this respect, the UK Treasury recently announced that non-discriminatory access regime for ETDs is not suitable in a UK-only context and that it will remove it. We believe that instead of weakening European ETD markets by way of implementing the non-discriminatory access provisions, trading on transparent and multilateral ETD markets could be further incentivized. A key reform to achieve this is the simplification of the current pre-trade transparency regime, which needs to be made more coherent for derivative markets. Many within our exchange community believe that a reasonable step to support the simplification of the regime generally is moving the SSTI waiver and recalibrating the methodology to determine list thresholds where appropriate. The pre-trade transparency regime is especially ill-fitting for commodity derivatives, and we all stand ready to work with ESMA in the upcoming review of RTS2 to ensure that the transparency thresholds are appropriately calibrated. Derivative markets are global in nature, and market participants are global as well. The more participants, the stronger and more liquid the market for those seeking to hedge their risks. This improves competition, keeps costs affordable for customers, and grows the economy. In this context, access for market participants, in particular liquidity providers, to derivatives exchanges is vital. While we understand the supervisory needs of national authorities and the importance of national rules, until there is a MiFID equivalent decision for third country investment firms taken, their access to European markets should not be impeded. Otherwise, these firms, key to provide liquidity, might prefer to trade in other jurisdictions. Lastly, market-making firms play a specific role within ETD markets as they help build sufficient liquidity for other investment firms to transfer risk in order to achieve their financial objectives. It is therefore essential to safeguard well-calibrated prudential requirements to allow them to continue their activity, therefore securing the ability of EU ETD markets to thrive in a global setting. As a South African with a Danish mother, raised in Hong Kong, living in London with my Scottish husband, I don't think it would be appropriate to conclude this speech without commenting on global interconnectedness, and in particular, the current status of the EU and UK discussions around equivalence and their future relationship. We welcome the finalization of negotiations on the Memorandum of Understanding, and we look forward to seeing this being ratified and implemented. I firmly believe that the strong relationship between the EU and the UK that we've all enjoyed for the past 50 years can certainly be restored, albeit in a slightly different form. UK and EU markets have evolved together and form two halves of one whole. Arbitrary divisions to achieve political ends do not serve either the EU or UK market and will ultimately lead to fragmentation and poorer outcomes for both economies. The UK necessarily needs to look at how to achieve a regulatory regime that works for its market, for its economy, and for its industry. It does so whilst welcoming international business, including European business and firms, into the UK in order to continue the trade and business that has always been undertaken there. Whilst we accept that we may see the UK's regulatory regime diverge in part from that in place in the EU, this will be down to both jurisdictions developing their legislation in a way that works for each of their own markets. It will not be for political point scoring purposes. One thing that will not change is the UK's commitment to the highest regulatory standards, the protection of all participants in its financial markets, and its openness to global trade. Thank you all very much for listening and for joining from wherever in the world you may be. And I will hand you back to Rainer. Enjoy the rest of your convention.
Well, thank you, Kirstina. And I think that was a very nice personal note at the end, but equally, I think very informative to highlight the role of exchange-traded derivatives and that exchanges really play in price formation and risk management and the sustainable transformation. So I think good that we brought ETDs, exchange-traded derivatives, a little bit to the forefront. And I think the points you highlighted, for example, on open access provisions, I think that's certainly something Europe needs to think how to be in line with global rules and not to do something where we should shoot ourselves in the foot. And equally on the pre-trade transparency regime, I fully concur with you. We need to simplify and again ensure that we're competitive. And I think your final plea was very much that, especially exchange-traded derivatives are vibrant, are global, you said. And I think the EU really needs to see that we ensure to be competitive on a global scale and promote liquidity and risk management in a fair and high integrity manner. So thank you very much for this. We conclude the morning. And thank you very much, Kirstina, and thank you very much for everybody listening. We will be back at 1400 sharp. The stream that you're listening to right now will resume at 1400. Thanks a lot. Have a good lunch.
Good afternoon, everyone, and welcome back to this FESE annual conference. I am Attia. I'm the Vice President of FESE, and I am Global Head of Primary Market and Post-Trade at Euronext. I'm delighted to welcome you back for this afternoon session. And before handing it over to the very exciting program that we have this afternoon, I wanted to do a quick summary of the different debates that took place this morning and prepare the ground for the discussions of the afternoon. First of all, we believe at FESE that efficient European capital markets and the success of the CMU are more important than ever in this unprecedented context of multiple crises. It is critical that the EU is equipped with a strong vision on the development of European public capital markets to ensure we can support our local economies in the recovery of today and in financing the sustainable growth of tomorrow. At FESE and at Euronext, we have the strong conviction that the true CMU can only be achieved by involving and addressing all market participants and stakeholders, from SMEs to the largest companies, from retail investors to institutional asset managers, from local regulators to supranational authorities. We also need to integrate and strengthen European market infrastructures, looking at the full financial chain and beyond. And it is our ambition as leading exchanges in Europe to form the backbone of this European Capital Markets Union by connecting local economies to global capital markets, helping companies raise funds and enabling transparent and efficient markets, essentially to finance the real economy. This morning was dynamic and impressive. The Commissioner highlighted the importance of strong capital markets for the recovery and advancing the Capital Market Union, including to support the mobilization of investments needed to meet the EU Green Deal targets. After that, David Wright skillfully moderated the first panel on the strategy of the development of competitive and attractive European public capital markets, concluding that Europe needs a more ambitious strategy with a debate on the level of society, on capital markets, as well as a clear political targets and timelines. European businesses, and particularly SMEs, need easy access to finance to be able to support an increase in jobs and growth. While the need for more equity in Europe is already key in normal times, it is even more relevant now in this crisis that the banking system on its own, we know that it is not enough, and so we need to boost the transparent capital markets. When solvency is in question, equity is needed to buffer exogenous shocks. Public equity markets offer exactly this to companies, an avenue to raise equity capital, and the CMU must help improve this access. Policymakers need to be more ambitious to deliver a CMU that works for people. We also need to foster a European equity investment culture. Obstacles against direct retail investments in illicit instruments, such as shares, bonds, and low-cost ETFs, must be removed, and employee share ownership should be promoted to foster an equity culture in Europe. A true CMU needs to empower citizens to realize direct investment opportunities into securities across borders without frictions and at a low cost. This morning again, we heard from the Slovenian finance minister about the ambitious targets of the upcoming presidency on the digital and sustainable agenda, as well as CMU, obviously. On market structure and data, more transparency, robust price formation, and a tape that actually delivers for any investor were discussed in the last panel. A true CMU can only happen if investors have the confidence to participate in European public markets. Competitive and efficient markets that deliver for issuers and investors are the foundation for growth and for innovation. Last but not least, we took a short trip to the world of exchange traded derivative with Kirstina Combe from LME, London Metal Exchange, and a fellow FESE board member. And Kirstina set out the need for Europe to have a competitive role in a global market. As a wrap-up, I would say that European exchanges are at the heart of all those initiatives to strengthen European public capital market by rebuilding transparent, integrated, and efficient trading venues. Now it's my job to announce the upcoming panels, and it is a very exciting afternoon. And so setting the scene, we will begin with the first panel discussion amongst a leader in European exchanges with Euronext, Nasdaq, and 6 group CEOs that will discuss about the core question, which is what is the value of exchanges, especially in delivering inclusive growth and empowering investor participation in a sustainable economy. And then we will have the honor to welcome Robert Ophèle, who is the chair of the French financial market regulator, the AMF. And Robert will focus on NR4D and ESAP. And cast ahead to the final panel on innovation and technology, which will assess Europe's response to the growing threat of cyber attack, the EU's role in balancing innovation, investor protection, and market integrity, and the need for more strategic investment in the development of artificial intelligence technology in Europe. I wish you an excellent conference this afternoon, and I will hand over to our first panel, and obviously Rainer, our master of the ceremony, will also conclude the day later. Thank you very much.
Thank you very much, Anthony, and excited and a very great pleasure to welcome three distinguished speakers, the CEOs of our largest three members, Adina Friedman, President and Chief Executive Officer of NASDAQ, Stefan Bujna, Chief Executive Officer and Chair of the Managing Board of Euronext, and Joost Disselhoff, Chief Executive Officer of SIX. Hi to the three of you. And just to maybe briefly set the scene, the panel, I think, brings together a very unique perspective on the exchange industry. As Anthony just said in our title, Being Inclusive Growth and Prosperity to Power Stronger Economies, we want to discuss two major topics. The first one, as Anthony said, the value of exchanges. But in the second part, we also wanted to do a little trip to sustainability and discuss that. And maybe to start with the second topic first, we really believe public capital markets are the most natural and fastest capital allocation mechanism to address this biggest challenge of our time and to really make the E, the S, and the G work. And obviously, the EU has a very ambitious agenda. The US is following suit now with the new administration. So I think we'll discuss a little bit how to develop robust standards, what are the required global solutions, harmonized approaches, and how do we get there. So I think this will be the second part of what we discuss. We'll start off with the role of exchanges. And I think all of us know the basic function of exchanges: contribute to the financing of companies, provide investment opportunities to all investors, guarantee participation in wealth creation for our society, and obviously complement public pension systems. Equally support the transformational challenges, be it sustainable, be it digital, and certainly enhance competitiveness and attract global capital investment. That said, I'll start with Adina and maybe asking, NASDAQ is managing exchanges on both sides of the Atlantic, and you have said we aim to set the pace for rethinking capital markets and economies anywhere and everywhere. And we heard a lot this morning that we need to rethink. So how does this really drive your mission both in the US and Europe?
Well, first of all, thank you so much for having me today, Rainer. It's great to see you. At NASDAQ, we've been focused for the last 50 years since we were founded in 1971, and OMX in the Nordics was founded in the 80s. And so we've been really electronic markets from our very beginning. And what I think that is important to recognize is over the history of the exchange landscape, regardless of the technology that comes in, exchanges continue to play critical role in capital formation, price discovery, and enabling entrepreneurs and enabling companies to find that capital they need to create jobs and grow their businesses and therefore grow the economy. So exchanges have and always will, I believe, play a critical role. As we look at the next generation of technology that's coming in, I think one of the key roles that NASDAQ plays, because we provide our technology to our own exchanges in the US and Europe, but we also provide the technology that powers 130 other exchanges around the world, is making sure that we are always willing to disrupt ourselves and leverage that technology to drive capital formation in the future. And I think that whether it's DLT, so the blockchain, or whether it's the cloud and machine learning, those elements of technology should be brought into the markets. And the whole role of the markets is to minimize friction and maximize access to capital. So I think that those technologies will actually play a big role in continuing to lower the friction and make the capital markets more accessible to everyday retail investors, as well as the most sophisticated investors in the world. So we are pretty excited to play that central role, to continue to be the center of price formation, allowing investors and buyers and sellers to come together in a frictionless environment.
That's probably also a great introduction to you, Stefan. Your slogan is the leading pan-European exchange with global reach and local presence, and you are complementing your family right now with the acquisition of Borsa Italiana. How do you sort of see the European capital markets evolving in the next decade or so, and what role will the Euronext model play? You're on mute.
Okay, you've heard this sentence several times today, I guess. No, it's a very open-ended question. I mean, the way I look at the world, Euronext operates capital markets and stock exchanges of Amsterdam, Brussels, Dublin, Lisbon, Paris, Oslo, and now Milan. And we have acquired last year, as you know, a CSD in Copenhagen and a power trading platform in Oslo. So the group has been transformed, but I mean, the reality is that I don't know. You refer to one of our motto, one of our slogans. We have piled up over the past 10 years very different headlines that always converge the same reality. We said that we wanted to power pan-European capital markets to finance the real economy, and then we said we want to connect local European economies with global markets, and then we say we want to be the backbone of the capital markets union. What does it mean? It means that for us, issuers do matter, and we believe that equity, issuers, own funds, companies are not the raw material of market infrastructures; they are the purpose of market infrastructure. We believe that post-COVID, and that has been, I guess, discussed extensively this morning, companies need to be better connected to equity financing, because investors are seeking equity, and companies need to finance growth and recovery with money at risk, which comes only from equity. So in this context, our purpose is to be the one-size-fits-all equity provider or equity connector for European economies. I'm saying European economies because that's where we are legitimate, because we operate with a single liquidity pool, which is enabled by a single order book and powered by a single technology platform. And because we don't like market fragmentation, we believe that the best way to create the capital market unions is to build an integrated liquidity pool. So that's what we have been doing with the Borsa Italiana transaction. Actually, Borsa Italiana represents now 34% of the top line of the Euronext group, and France represents only 28% of the top line of the group. So we are becoming generally European. And the fact that we have been able to create with our Italian friends the first venue for equity listing and equity financing in Europe, with 1,900 companies listed in Europe, out of which 1,000 SMEs, with 5.1 trillion of aggregate market capitalizations. The fact that we have been able, with our Italian friends, to build the first venue for cash equities trading and ETF trading in Europe, with about 12.5 billion of average daily volumes, and that we continue growing in post trades, that we are continuing leading the path in government bonds trading, is allowing us to create a home for integrated, distributed, interconnected markets, and that's a purpose that is needed, because there is no fatality in being. Europe is not a continent of, or is not doomed to be a continent of finance takers. We can be finance makers, and we are not doomed to be part of a division which is Europe, Middle East, and Africa. Because Europe is home for us, and we can build strong Europe-based market infrastructures. And I completely agree with what Edina said. as long as we remain relevant in terms of operating performance and relevant in terms of innovation. Don't get me wrong, the focus on issuers, the focus on equity does not mean that my dream is to be a custodian of stock exchange museums across Europe. And that's not what we are doing. What we are doing is really to make sure that we offer to real commercial projects, to real ambitious entrepreneurs, to large cap companies that need to go back to global markets, connected with the local identity and the local ecosystem, the right solutions. And I think that's something that complements the full equity financing chain that goes through seed money, private equity, and public equity.
Mm-hmm. Thanks. And Joost, maybe a very different perspective from you, because SIX is still owned by its main users. So I think in comparison to Euronext and NASDAQ, which are exchange-listed companies, you're still user-owned. And obviously, Switzerland is outside of the EU. You just purchased the Spanish exchange inside the EU. What is your value proposition and sort of the vision for European capital markets?
In essence, thank you very much for having me here, by the way. But in essence, the value proposition is very similar to what Adina described and Stefan described. In the end, you really want to fulfill a role that helps the economy, the real economy, to progress, and really be closely embedded, connected to the key stakeholders in Switzerland and in Spain, and internationally, to really understand what the key functions and the key adaptations that our customers are looking for on the issuer side, on the trading side, or wherever a stakeholder who it might be that is connected to us. So really deeply embedded into the local ecosystems. But on the other end, of course, we are also a platform business. So having platforms at scale with volume to cover the costs, with technology to expand services quickly and to benefit from new technologies and new capabilities is also very much what we have to offer. And as you mentioned, we are user-owned, user-governed, so our shareholders are also our customers. So for us to be not aligned with our customers is absolutely no option at all. So longer-term strategic view on where our customers are going, where they are seeking their competitive edge, where the markets are going, is the only way for us, because we don't have to report every quarter our numbers. We can take a longer term view and make more strategic or make strategic investments in technologies and capabilities on behalf of our customers and for our customers. And we have many examples of those initiatives. So platform business, making sure you have economies of scale and capabilities and an economical model which is sustainable going forward, being a really reliable partner and connected to the stakeholders in the markets that we operate, and drive innovation through technology and new capabilities. That's what we have to offer.
Maybe I think in the common thread between all three of you was a little bit primary market and secondary market. Let's start with the primary market maybe first. If I look to the first panel this morning, we discussed a lot of issues why capital market union doesn't really work that well so far and what needs to be done. And I think, as Anthony said, the summary was a little very much we are too fragmented. We have different accounting rules, different insolvency rules. We have different trading platforms, a lot of dark trading. And at the end of the day, for many SMEs and issuers, it's very difficult to tap the markets. And maybe I would pick a little bit, Adina, maybe you run a very successful franchise in the Nordics and obviously in the US. What are sort of the differences you see? And maybe after that, Stefan can come in, maybe report a little bit. What do you think we need to do on the primary market side to make CMU work?
Sure. Well, I think first of all, with regard to our Nordic markets, one of the really big benefits we've had is having the regulators work together in the region to create a more unified approach to capital formation, capital raising. The rules are slightly different from country to country, but there is a fair amount of harmonization that the regulators have facilitated that allow for our markets to have a more structured and standardized experience, both for the companies that are raising capital, the market participants and as well as the investors. So that's, I think, the first thing that I would point to, and it's something that we really paid a lot of attention to 12 years ago when we were evaluating the merger with OMX. I think the second thing is that NASDAQ Nordics have really developed the First North market, which is our SME listing venue and trading venue. And so we have a really, I think, a spectacular ecosystem for small to medium-sized companies to come and tap the public markets, raise capital quickly and efficiently, and an equity culture within the Nordics that really have tapped both retail and institutional investors to invest in those companies. When we look at the Nordic countries in general, equity ownership among retail investors is significantly higher than other parts of Europe. And I think that goes to the overall risk culture that the Nordic countries have promoted, both in terms of the social system that creates a really good system for everyone who lives there in terms of allowing for savings for retirement and obviously for education and other great elements of their society, but then also encouraging investors to make equity investments and be a part of the growth of the economy. And I think all of that has really created the recipe for success in terms of having a vibrant SME market, a vibrant, full large cap market as well. And then we've obviously brought over elements of the US markets into the Nordics, and the Nordics have brought elements of their markets into the US. So we have, I think, a really good ecosystem that we've created.
Stefan, what does Euronext do for SMEs?
No, I mean, as I told you, out of 1,900 companies listed on Euronext market, more than 1,000 are SMEs. This is a part of the fundamental DNA of Euronext. We operate as an integrated single liquidity pool with a college of 7 regulators or supervisors who monitor the implementation of a harmonized level 1 rule book with some nuances in the level 2 rule book, but the convergence is very strong. Clearly, where you can see nuances is on corporate law and tax law that have nothing to do with stock exchange regulations, and that really matters. Actually, what we are experiencing, I think all of us, since the beginning of the year with the rebound of IPOs, is that it operates as a sort of acid test as to who is competitive and who is not. And just to talk about Euronext market, we have a boom of IPO as in Oslo, in Amsterdam, and in Paris, but we have some other Euronext locations that are less attractive, not because of the liquidity, because we have a single liquidity pool, not because of listing rules, because they are massively convergent, either through the Euronext rule book or through the European EU directives and prospectus. What makes the difference are things that have nothing to do with those rules, like tax law, corporate law. I mean, the success of Amsterdam on the SPAC role has to do with the availability of tax rulings in the Netherlands, or with the flexibility of Dutch law in terms of use of English language as a corporate language and these sort of things. Oslo is very attractive because it was attractive because before it joined Euronext. Now that they are part of Euronext and that they are fully connected to the single liquidity pool, the only weakness that was the quote-unquote Oslo historical weakness, which was the limited size of the local liquidity, has disappeared, and you get all the benefit of being with a group of local peers, companies in shipping, in seafood, etc., plus the depth of the liquidity provision. So I'm not that nervous, because every time markets are really integrated from the backbone point of view, from the liquidity point of view, the flows come. I mean, we have the competition of private equity and these sort of things, but they don't come from fragmentation of stock exchange rules.
And Jules, maybe a couple of questions to you. Number one, when I think about, Stefan just said peer group, when I think about Switzerland, I think you've been really successful in pharmaceutical and biotechnology, for example, as an exchange. How does that sort of change now with the BME integration? What is sort of what you think needs to be done for issuers? And maybe to go a little bit into the secondary market, this morning we discussed a lot fragmentation. And maybe I think being inside and outside of the EU, you maybe have a perspective on that as well.
Yeah. Just quickly looping back to the SME discussion, if you allow me. I think one of the things we really we really need to campaign more is that actually transparency is good. And still one of the main issues for many SME companies is this fear of, if I go to the stock exchange, then I'm in the magnifying glass and everything is transparent. And we should actually explain that that's a good thing and not a bad thing. Just additional to what Dina and Stefan already said. Both the Spanish market and the Swiss market have strengths in certain sectors. And by now having one group, by integrating our technology, giving the stakeholders to the markets single access to both markets going forward with same technology and same connections and same protocols and everything, our customers can benefit from both the strong segments in Switzerland and the strong segments in Spain. So that's really beneficial. Of course, the underlying economies are very different and have very different characteristics, but our customers now can benefit from both third country, strong economy with pharmaceuticals and many other strong sectors in Switzerland, and having a direct connection into EU through Spain. So that's really what we have to offer now compared to when we were both alone.
Yeah. And maybe, Stefan, you want to comment a little bit on the fragmentation in secondary market? I think that was discussed very intensively on the panel this morning, market structure, market data, and how we, I think, need to try to have a more transparent trading. How do we get there?
No, I think it's a debate between grown-up adults that we need to have with our regulators. They need to figure out what they want to achieve. The way MiFID II was structured and designed was to create more transparency and to create some buffers for large blocks for some exceptions. For all sorts of reasons, we end up in a situation where nothing really changed in terms of market architecture versus what it was before MiFID II, and that there was a sort of rebranding of dark pool, of OTC into systematic internalizers and all sorts of creative schemes. Fine. But as long as we describe reality as it is, and that we don't pretend that the goals of MiFID II have been achieved. Now, we are, from a fundamental market architecture point of view, exactly back to square one. It's just that the names of the objects has changed. And that's what we need to discuss. So we all have the same difficulty because the people which we are quote unquote debating with are also our largest clients, and we need to have a sort of a reasonable discussion where we need an adult in the room, which probably needs to be a well-informed and well-prepared, balanced supervisor to decide what is the right level of what is the right market architecture. So I'm confident that we will get where we need to be, but it's not by fooling ourselves or by lying to ourselves about claiming that the data are not accurate, etc. Let's be honest. What is good for client? What is good for particular the most quote unquote asymmetric clients or vulnerable clients like the retail? Let's see that whenever we make a decision from a supervisory point of view or from a regulatory point of view, who is winning and who is losing. Let's make sure that when decisions are being taken on things like consolidated tapes, we don't have all sorts of unwanted consequences in pay for order flow or these sort of things. It's such a matter of being lucid and rational. I'm not again pushing for status quo. Competition is welcome, and Euronext has re-emerged for its complicated situation by fighting against fierce competition, by working hard on the operating performance, not by building walls. And I'm not suggesting that we build walls. I'm just saying that we need to we cannot fool ourselves by playing with the wrong concepts. If you want transparency, then you need to tackle what is OTC and systematic internalizers, because that's not good for retail investors and not good for transparent numbers. If you want to have available data, I'm not sure a pre-trade consolidated tape is the right solution. So let's have this type of discussions, because otherwise regulation ends up to be precisely wrong rather than roughly correct.
Yep. Very, very good point that I would ask Adina. I think you're looking at that from the US and you must be mystified because you have a consolidated tape since the 70s. And I think very often the US is touted as the example. However, we've also seen with GameStop and other things that in the US, the world is certainly not perfect. So what is sort of your view on fragmentation and transparency, and how do we get the European market structure and data right?
Well, first of all, I would agree that there is no perfect market structure out there, and that's actually one of the things that makes this world so fascinating. And it's an eternal learning curve. You know, the markets are always changing. So, but when we do look at the U.S. and we do look at, well, first of all, there's fragmentation in both the U.S. markets and the European markets. But there's one big difference between the U.S. markets and the European markets, and that is we have the data that allows us in the U.S. to evaluate that fragmentation in a very analytical way, because all of the data on a post-trade basis, and once the trade occurs, it's reported into a consolidated tape. So we know exactly how much fragmentation there is. We know when a stock trades hands from a buyer to a seller. It could be from one professional buyer to another professional seller, but it could also be from a retail investor to a market participant, or from a buy side to a buy side. So, but we have that data available to us. We have a complete record of every trade that occurs in every stock. And when I look at it from the corporate's perspective, so Stefan talked about one of our key responsibilities is to corporates. For them not to know how much trading occurred in their stock and where those trades occurred, it seems kind of antithetical to the transparency that we are supposed to be providing to our clients. So I think from a post-trade basis, we created something called ACT back in the 1980s that allowed for all trading of securities not listed on an exchange to be able to come and be reported both publicly, so retail investors have that transparency, and to regulators. And we have a lot of rules around it. So you establish, so that you make sure you're not double counting, you have a very specific set of rules. I think that is a very important next step for the European markets together to create a post-trade consolidated tape. I agree with Stefan, a pre-trade consolidated tape isn't as necessary because there are only a few venues that actually provide real-time transparency. And the vendors already do a great job of combining those and providing that pre-trade transparency that the world needs. What we need today is a post-trade transparency. And that, I think, will eliminate a lot of the debate as to whether or not there is dark trading, how much dark trading there is. And it allows us, therefore, to use data to analyze what do we want to do about the fragmentation that occurs in the European markets. Clearly, the U.S. hasn't necessarily solved that challenge, but at the same time, I think one of the elements of the U.S. markets that I'd like to say that I think is important, and it will probably persist as well in Europe, is competition is good, choice is good. Allowing, though, for the exchanges and the dark pools and the internalizers to operate on a level playing field from a competition perspective is very important. So those are the things that I would say the U.S. continues to work towards, but at least we have the data to support it. So let's start in Europe by getting a better set of data, and then we can look at, okay, then how do we harmonize the rules across the various participants to make sure we have a level playing field?
Well, I think a very powerful summary probably of what we also discussed in the morning. I think we need really a post-trade consolidated tape for best execution verification to exactly not do what Stefan said, get the regulation exactly wrong, but rather try to get it a bit better, roughly correct. I think that is, in my view, certainly something we need in Europe. Let's maybe move a little bit over to sustainability and what role exchanges play there. And I think for me, as an economist, I was very startled when about a couple of years ago in the MEP, an MEP asked me, a member of parliament asked me, well, what do exchanges have to do with sustainability? And he thought that was more a thing for the banks, where the banks have their ESG guidelines and mind that in lending. And I think I then went out to say, well, capital markets are certainly where we trade on a daily basis in a real-time fashion, and we reallocate capital to the most productive use. And if digital or sustainable transition are the thing, then this is certainly, it shows in the stock exchange. But of course, we need to think about issuers, and we just talked about issuers. So I think this is the question, probably, how do we get to global standards so everybody tries to speak the same language? And maybe, Stefan, you can start with it. The US has really been the pioneer with the taxonomy, and also now the reporting is taking shape. Are we moving fast enough, and how can we really bridge that gap between issuers and investor, and what role can we exchanges play?
Well, it's a very open-ended question, but I mean, let's try to make things a bit simpler. The job of exchanges has always been for centuries to connect people who have too much money with people who don't have enough money, and people who don't have enough ideas with people who have too many ideas, and to make sure that people who have too many ideas and not enough money meet the ones who have too much money and not enough ideas. That's what we do. Now, for centuries, it was very simple. People were looking for performance, for yield, and for liquidity. Now, for the past 10 years, they seek performance, yield, liquidity, but also contribution to climate changes, resistance, to contribution to society, and contribution to transparent governance. Fine. So our job remains the same, to make sure that investors can spot the relevant projects, and to make sure that companies can show their projects that meet those standards. It is as simple as that. Now, being neutral, being in the middle, being a facilitator, being an accelerator, being by nature, being a native connector, makes us the most relevant player to accelerate this transition. And I think that makes us absolutely critical. Now, clearly, there is a sort of fundamental dynamics happening within the issuers world and within the investors world. And probably the decision of BlackRock in January 20, or decision of Amundi in Europe in January 20 as well, as being more fundamental in terms of driving rivers of money towards this type of projects. But we need to be able to accelerate that. In terms of taxonomy, I'm glad that Europe took the lead in the context of the Commission. The big difference between performance, yield, and liquidity that are numerical and relatively objective versus contribution to climate, which could be relatively objectivized, but contribution to society and to transparent governance, which cannot be necessarily objectivized, is that these are political collective preferences. That's fine. That's fine. I mean, labor law is a collective preferences, and that's fine. But we need to make sure that these are designed not by accountants working together, or not by a very powerful index or rating agency that decides that ESG is just one product or one segment alongside credit rating, but that people who have in charge of shaping views about what is right and what is wrong, with a political mandate to do that, decide what is contribution to society and what is diversity. And to give you an example of one of the fascinating debates I have as an issuer with investors in Euronext, especially US investors, when it comes to the G of the ESG, and when they ask questions about the governance. Now, we contribute, we do our best with gender diversity, and actually 40% of the supervisory board members of Euronext are female board members. But then sometimes some US investors come with a question about ethnic diversity. And then you can see that there is a big difference between the US and Europe. Because in US, where civil rights were granted in the 60s to colored citizens, they have an issue which is specific on ethnic diversity. In Europe, the only moment where we had ethnic statistics in the European history was between January 1933 and May 1945. And the experience of Europe of ethnic statistics is very bad. So that's why we have a different approach of diversity and of this concept of ethnic diversity within boards. Actually, the only two countries that were not affected during that period by ethnic statistics are the UK and Ireland. And that's probably why the UK is more open on ethnic statistics than the rest of the European continent. So my point is that we need to position exchanges as key players in this transformation, while recognizing that when it comes to the substance of those various tests, the more they reflect genuine collective preferences, the better, because nothing would be worse than to have imported a test that will not match with who we are.
But I would say transformational readiness highly depends, obviously, on also diversity. And I think certainly cultures are different, histories are different. I would fully agree. And racial statistics, rightly pointed out, are problematic in Europe. But Edina, I think in the US, you're taking steps, and I think to encourage more diversity in boards. And I think there's a lot of academic literature supporting that actually more diversity in boards will yield to better governance, will yield to better outcomes. Maybe you can tell us a little bit what's happening in the US there.
Sure. Yeah. So NASDAQ in late last year made an announcement that we've gone to our regulator, the SEC, to ask for approval to establish new transparency requirements to list on NASDAQ. And those transparency requirements specifically relate to providing a standardized way of self-reported information of the board members, the board composition from a diversity perspective, both in terms of gender and ethnic diversity, as well as to encourage our companies that are listed on NASDAQ to establish at least one woman and one other underrepresented minority on their board over the next 4 years. The only obligation is for them to, if they are not able to meet that standard, is to disclose why not. So it's really what we call a comply or explain rule. We are really, we're dependent upon the nature of transparency in the US. So, the US capital markets are really founded on the basis of transparency. So if investors have the right information, they can make the right decisions. So we have a standardized table, and then a way that for companies to explain their plans with regard to adding more diversity. And you're right that the reason we did it was because of the fact that the research, there's a mounting amount of research that shows two things. One, having more diversity on boards leads to better risk controls, and also there is some correlation of having more diversity and better financial performance. But the risk controls are interesting because I think that if you think about it from an anecdotal perspective, when you go outside your own personal network and you establish a board comprised of people that may not be part of that network and that are coming in as professionals to really evaluate the performance of the company, they might ask different questions. They're going to look at the company through a different lens, and they allow you to have a much more well-rounded view of the company, both in terms of opportunities, business opportunities, but also in terms of managing and controlling the company from a risk perspective. So I think that there's, kind of think about it anecdotally, it makes sense, but the research is now showing it to have a high correlation. So we believe that this is the right next step for the U.S. markets, and we are hopeful that the SEC will approve it in the next few months. There's a comment period that is established in the U.S., and 85% of all the comments that have come in so far have been positive, coming from investors, coming from corporates, coming from other advocacy groups. So we're pretty excited about what we're doing.
Right. And Jos, maybe a comment from your end, right direction with standards and governance, where you're sort of positioning yourself. You're following the European debate, obviously.
Yeah, of course, very closely. We always stress that the role of the exchange is already a sustainable role. It's really providing a platform where investors can and companies can come together, as Stefan described very, very well early. And that is the fuel of the economy that you need in any point in time, in any cycle. You saw it now also in the COVID situation, where if markets really get turmoil, the stock exchanges are there, they are predictable, they're reliable. Some markets have made small adaptations with short selling, but others not. But they are there to sustainably create this platform for investing and divesting and raising capital. Of course, we also are providing more and more products and services around ESG and sustainability. We've launched an ESG index, a diversity index, all these kind of things we are focusing on. And it is actually really a shame. And I think also in the long run, it will not be required what you've done in the US, Dina, that you make it a rule. I think in the end, the investors will decide. The investors will say, there's no women or there's no minorities on the board, I'm not going to invest in that company. Or there's no proper ESG focus, or they're polluting the world. Whatever the criteria are, in the end, the investors will decide, and they will make their choices where they put their money. And these things will therefore will have to be attended to by the companies who want to have a sustainable future themselves. So, of course, we need to have some rules and obligations to get things going. But in the end, the investors will decide with their feet in which type of company they will invest in. And I'm sure that companies who do not address these topics will, in the end, not sustain.
So yes, I agree with that. I think that the key, though, is to have the data available to investors so that they can make an informed decision. And that's where I think whether it's the regulatory authorities in Europe that are really focusing in on establishing standardized ESG reporting, or whether it's our proposal that's requiring a standardized table, it just allows for investors to have the information they need to make an informed choice. And I think at the end of the day, that's what we should be focused on. Not so much, you don't want to put the gate up and make it so that investors don't have access to companies because of certain rules, but more that they have the access, but they also have the information they need to make that choice. And I think in a sustainable world, that data is going to have to become as standardized as possible. And I think it'll be interesting to see how the European regulators address it. And now, of course, the US regulators are also making a pretty big stand that they plan to address that as well.
Yeah, big debate also in the discussion around corporate sustainability reporting and governance, and there whether to use, I think, legislation or code of conduct. And I think, Stefan, any view on that? Because I think the code of conducts obviously also have their criticism, but certainly gives issuers, and that was Florence Brindel from European Issuers pitch this morning, obviously gives issuers more time to transition, obviously allows for more flexibility. So where would you maybe land there, Stefan?
By nature, I believe that flexibility and bottom-up harmonized rules are again on the same concept of being roughly correct rather than precisely wrong. Is always this code of conduct approach is producing more relevant guidance than some form of artificial top-down metric that may be obsolete at the moment it is enacted, or may create all sorts of unwanted consequences that could not be anticipated in good faith by policymakers. So I totally agree with that approach. What we need to do is to be ready to contribute to the production of this grant, to have an opinion, not to be passive. I think it's not, if you don't, to use a paraphrase of Kennedy, if you don't take care of ESG data will take care of you. So we have to make sure that we that's why I'm such a big fan of the European Commission taxonomy exercise. It's not very fancy, it's not very fun, it's not very glamorous, it's not very aesthetic, it's a bit chaotic, but at least it's done in the context of a very intensive, deliberated debate. And we know that the people who do that are indirectly elected by the citizens of Europe to form an opinion on what is contribution to society and what is diversity. I think it's at the end of the day, it's this combination of global view by political directions, but bottom-up emergence of the details through code of conduct is probably the right combinations. The mess starts, the confusion starts when policymakers do MiFID II type of exercise to be super granular and super detailed on all sorts of things, and then 3 years later you realize, oops, we were wrong, and then there is no path for adjustment in a timely manner. So code of conduct better.
Maybe since all of you mentioned transparency and data as key, maybe as a final question on sustainability, let me ask, what are the exchanges doing? And I know a lot of you have invested in companies, for example, providing ESG data. Joost was alluding to ESG data and indices. Maybe the same question to Edina and Stefan. what role do you see there really for you, and what kind of work are you doing?
Well, I think actually, Stefan did, that was an interesting commentary, Stefan, on the code of conduct versus a very prescribed set of very specific standards, because I agree. I think that this is going to be an evolving space. So, and the one nice thing about the exchanges is that we can work with our corporate clients, we can work with investor clients to come up with an approach that works for the markets in which we operate. But I also, in terms of what we're doing, I think in the Nordics, we actually have established a set of data points that we're asking but not requiring our companies to provide, that gives investors a more standardized way to evaluate a sustainability and environmental impact. And as a result, we actually have several hundred companies that are providing that data on a voluntary basis. And we like that approach of kind of working with the community to find what works. Now, I think the challenge for very large companies, global companies, whether they're European based or US based, is the fact that they then have to deal with a lot of different regulatory regimes to gain access to different investors. And that's the challenge. So I think that if you think about an organization like IOSCO or others where they've established kind of a framework for everyone to work within and a code of conduct type of approach, and then allowing the local ecosystems to figure out what kind of works best, it's kind of an interesting way of looking at it. But I do think the more we can standardize but not make it so that it's so prescribed that it's not actually that relevant, I think the better. This is going to be a fine line that we're going to have to walk together with the regulators and with our clients to find the right balance here across the US and Europe.
Maybe I know I can be more concrete. We are like many of us around this table, but maybe probably the number one ESG index provider in Europe for structured products since 2019. And recently, and this momentum in producing ESG related indexes has accelerated. Recently, we launched a CAC 40 ESG in France, and we are about to launch other ESG related indices across Europe. So when you do those type of indices, you need a data provider. You need someone who ranks for you, who is first and who is 40 in terms of 30, 40 ESG standards. And then in concrete terms, you bump when you build an ESG index to three fundamental issues that you need to tackle with your data vendor, which have nothing to do with the 40 type of tests or metrics that are being measured. You need to secure that the guys you pay to deliver data to you are really independent and that they don't sell services to issuers to improve their ranking, as some proxy advisors do in other dimensions of corporate lives. And that's an issue that is specific to the complexity of ESG data. You need to find a way for timely review of those data, because annual review may not be enough to be fair, because each issuer does initiate major initiatives that could be unfair to have reviews only through the annual reports of companies. And how do you shape these timely reviews of ESG data is critical. And the third thing is, how do you manage engagement between the data provider and the issuers, because people need to talk to understand, to filter what is just corporate buzzwords and what is reality. And that's very different from audited numbers on performance, EBITDA, revenues, and net income. And the complexity of data provided by data providers, which above and beyond the fact that collective preferences are different on Edina's side of the water and on yours and mine side of the water, beyond that, in any event, on both sides of the water, we need to manage that particular complexity of fragmented and qualitative data. And that's what we do, at least as index provider. And I'm sure any other exchange that is building ESG indices as we do is facing the same reality. How do we make sure that our data provider of ESG is reliable and consistent and operating in a timely, independent manner? And that's our responsibility to secure that.
maybe Adina, then Jos, you briefly want to comment on ESG data and products and what you're doing there?
I think
Sure,
Stefan is
maybe Adina first, and you, Jos.
Sorry.
Oh, no, that's great. Go ahead, Jos. Go ahead.
No, I was just saying this independence and how often do you review and refresh the data and how do you make sure that engagement is going are very important topics. And we have a little bit the lucky circumstance that 1/3 of my business is the data business. So we are a data provider ourselves. So it is really our business to understand the integrity of data, the data that we produce ourselves or the data that we procure, how to normalize that and to make sure that that becomes a standard. And I think in the role of exchanges, this data element and having a data business in your portfolio, I think will become more and more important to address some of the issues that Stefan mentioned rightfully.
Adina.
Yeah, in fact, we use a lot of SIX data in our index business. So, but I think that in terms of how we've decided to focus in terms of serving our clients around the topic of ESG, the first thing we've done is really focus in on the corporate clients and understand that they are navigating a pretty complex world right now. You know, as you've talked about, there's a plethora of rating agencies out there that are rating these companies. In some cases, it's a bit of a black box as to how they're doing it, which I think should be, in my opinion, should be made more transparent to the companies. But then also, I think that they get inbounds from investors in terms of questionnaires, and so it's become this deluge of work for these very small IR departments within companies. So one of the things that we've done is create an advisory service that helps the companies navigate this. Well, where should you? Number one, what programs do you have? Number two, how should you communicate those programs to investors and to the rating agencies in a way that they'll pick it up and they'll rate you appropriately? And then third, we provide them a reporting tool that you put it in once and we map it out to all the different rating agencies in terms of normalizing the data and making it available in the formats that they want it. And so we've been really looking holistically at how to address corporate issues. The second thing is then also looking at sustainable financing. So we have our sustainable bond market in the Nordics and now the sustainable bond network that's global that allows issuers to come out and register their bonds as being sustainable with the data that supports it so that investors can make informed decisions around investing in those bonds. And then as of today, we actually announced a majority investment in Puro Earth, which is a carbon removal, it's kind of a carbon removal market. So basically allows corporates to find carbon removal projects to invest in to help make sure that they remain carbon neutral. And so many companies have made that commitment, but they can't necessarily turn off all the lights in their buildings. So they leverage the carbon removal market to help them manage their carbon footprint. So those are the areas that we've been focused on within NASDAQ to help contribute to the ESG focus, but to do it using market mechanics.
So our time's almost up, and our last panel will focus on innovation. And maybe I wanted to ask the three of you, and maybe the order Stefan, Adina, and then Jos to briefly comment without taking away from our last panel. But I think if we look at financial market infrastructures and innovation, there's obviously a lot changing: artificial intelligence, DLT, etc. What do you think is the biggest transformative thing that you're seeing in your business? And where do you sort of see innovation driving our industry sector? Stefan.
You know, when we look at innovation within Euronext, I try to segregate innovation in three categories. What are the pure buzzwords, basically, that drive a lot of fancy, nice things? And clearly at Euronext, I'm not in the business of showing up with a black T-shirt and an earphone and put slides on change of paradigms. This is not us. Second, what are the enablers that do transform the way we do what we do? And what are the profound transformational technologies of our business model? The reality is that there are many buzzwords in what we are observing. There are very, very few profound transformational technologies that transform our business so far. There are incursions in the CSD business of distributed ledger, which is more relevant, and in other parts of our business that are more relevant. Anything that we do which is latency critical, is not a good friend of blockchain. But for whatever we do, which is slow, blockchain is great. But there are very few of those. And then you have in the middle a lot of technological informations that are significant enablers, significant tools to improve the way we do things. But that are not necessarily transforming who pays whom to buy what service. And that's what we need to be aware of. So a lot of our time is driven to, can we calm down and decide what is a superficial buzz, what is going to threaten us and to put us in a sort of Kodak moment where we can be great but irrelevant from a technological point of view. There are very few of those, but there are potentially some trends. And how do we manage operationally in the most efficient manner the enablers in the middle where artificial intelligence, robots are not buzzwords. They are real. And blockchain, for part of what we do, is not a buzzword. It's real, but it's not like all industries not changed so far by a different technological paradigm. We have to be ready. I mean, maybe one day the equivalent of what we experienced in the 80s, 90s, which was the digitalization of our markets, will happen within the digitalized world with the same magnitude as what we observed in 1890. But my intuition is that, and again, this is where the topic on which we spend most of our time. We are not there yet, I feel. But again, this is a very conservative comment.
I would agree.
But again, it's not because I'm cautious that I am a sort of Amish guy who is a big fan of oil lamp and horse carriage. I just feel that we have to be reasonable about, because we don't have a mandate to invest. We are not VCs. We are
fully agreed.
Managers.
Let me just briefly interrupt because our time's coming to a close. Adina, briefly.
Sure. Well, I think that what Stefan said about being ready is important. So the technologies that we really focused on are the cloud, machine intelligence, and blockchain. So I think that those are the three buzzwords as Stefan has talked about, but thinking about being ready. So to us, enabling the markets to operate in a cloud environment, in a hyper low latency, digitally connected environment, and allowing the technology to be a lot more nimble and adaptable, I think are the things that we are focused on today. So our next generation trade lifecycle technology is cloud native, and it's modular so that it allows for changes to occur a lot faster. I think that the next thing then is to take advantage of all the data and what I'll call data-centric architecture that allows you then to tap into all the data you have across the trade lifecycle and get intelligence off of that using machine learning. And then the blockchain is an interesting disruptor, and I think it's one where it's gone from a concept to POCs to now some real implementations, and I'll leave it with us to talk about that allows us to rethink how buyers and sellers find each other and how we record trades. But I'd also agree with Stefan, it'll be a long time before that type of technology takes hold in the mainstream regulated markets. But we are seeing that definitely in new markets. That's kind of how they want to establish themselves with that the record-keeping capabilities of the blockchain. So I'll leave it there.
Jos, you're developing the digital exchange for a few years.
Yeah. Just very quickly, of course, we run a payments business, we run a data business, and a stock exchange business. The payments business, huge transformation from everything to do with paper to electronic, so bills, cash, whatever. So that's a big transformation that we're pushing and supporting. On the data side, as Adina very rightfully said, new technologies, APIs, cloud, many other things are really driving that business in terms of how you get the data, how you analyze data, and how do you deliver the data then to your customer. And on the exchange side, we are a true believer, and I think to Stefan's words, we want to be ready if digital assets cross over from the traditional exchange business and cryptocurrencies, and those worlds start to meet, then we want to be there to have a fully fledged digital asset exchange where indeed all the post-trade processes will happen on the blockchain, And the trading itself with latency will probably happen more on traditional technology, where those two worlds actually come together so that we are ready to serve our customers when the transition happens and when digital assets really become more and more part of the capital markets. And we make big investments in that. That's almost like a VC kind of activity, Stefan, but that's perhaps the advantage of having a user-owned, user-governed structure, that we can take longer-term bets where we can for a couple of years. Yeah.
No, thank you so much. I think that was a great debate. We could go on probably another hour, but I think what we certainly brought across very well in this panel, I think, is that primary and secondary markets matter, and I think that exchanges are very committed to continue to work with issuers and investors to promote efficient markets that I think foster economic growth and transparency, and I think continue to power the economy, and also what role we play in sustainability, which I think is an increasingly important topic, of course, for all of us in our daily lives with climate change. So I think a big thank you to the three of you. And with that, I think I'm to introduce our next speaker. That's Robert Ophèle, the chairman of the French AMF. And I would say, Robert, the floor is yours. Hi there.
I am in the show. That's what I read.
Very well. You're welcome.
Good afternoon.
Good afternoon.
Thank you for inviting me to have a few words. Sustainability and digitalization, which are the topics of the two panels this afternoon, are obviously the two main challenges facing our economies, and the financial industry lies at their core. Largely speaking, sustainability and digitalization are different domains, but if we wish to boost our economies, we need to draw maximum potential from both of them. The financial sector has a key role to play, notably by favoring investment in both sustainable activities and the transition to more sustainable activities, and by gaining efficiency with the recourse to digitalized processes. In order to meet these challenges, ambitious regulatory proposals are on the table at the EU level. This in itself is fortunate, since the national level has its obvious limits. The proposed regulatory frameworks could deliver a decisive step forward, and there is a need to deliver rapidly on both fronts. Nevertheless, in both cases, these proposals have triggered criticism, and this afternoon there are two shared types of danger on which I intend to focus. First, the danger of being overly complex. Actually, and to best grasp these two challenges, several issues need to be addressed both consistently and simultaneously. Let us be straight, this is not a given, and I firmly believe that many of us today lack a clear and full picture of the state of play in both areas. Yet, without a set of consistent and fully understood requirements, there will be no support for such wide-ranging reforms. Second, from the rest of the world, there is a strong degree of international interdependence, and there are possible extraterritorial consequences of any regulation in these fields. Achieving the expected outcome without achieving the right balance in order to set requirements that deliver the expected outcome without isolating the EU and being at the end detrimental to our financial industry is also highly challenging. Let me come back more precisely on these two dangers: over-complex and inconsistent regulation, and then the risk of over-Eurocentric regulation. Quite arguably, when considering the taxonomy regulation, the corporate sustainability reporting directive, the sustainable finance disclosure regulation, and the new delegated acts concerning product governance and investment advice, one could be in some doubt as to whether the average corporation or the average financial service provider is able to first fully understand and then fulfill what is required of it. Reacting to this perceived complexity, some stakeholders react bluntly. They advocate that in order to avert these requirements, SMEs according to the CSRD definition, SMEs would shun the regulated market, and many financial service providers would abandon their investment advice activities and focus on order reception and transmission. Critics also stress that the EU has put the cart before the horses by first laying down disclosure rules for investors regarding sustainability and then taking care of establishing a sustainable reporting standard for issuers. In the meantime, such awkward inversion significantly contributes to reinforcing the role and influence of third-party ESG data providers, as well as the pressure on issuers who are routinely asked to fill in dozens of duplicative questionnaires. Failing to address excessive complexity would be detrimental to us all. Sustainability disclosure cannot be a constraint waiting solely on companies listed on a regulated market. The impact of a company on climate change does not depend on whether its shares are listed on a regulated market, nor on its staff number. Demand for disclosure from investors and financial intermediaries goes well beyond listed companies and covers all types of financing. And demand for sustainability information stems not only from the financial community of investors, but also from a wide spectrum of stakeholders at large. By extending the number of firms covered by NFRD from 11,000, if you take into account national options, to a minimum of 50,000, including large companies listed or not, the proposed directive is taking the right approach. Furthermore, in my mind, it should be clear that this is just an initial step. At some point, sustainable disclosure would need to stand on an equal footing with financial disclosure, even if the proportionality principle warrants lighter requirements for smaller companies. As a matter of fact, we should be careful not to widen the existing gap in terms of disclosure requirements between listed and non-listed companies, which is eventually detrimental to the attractiveness of public markets. Investment advice has also a clear value added for many unsophisticated middle-sized investors. Making this too burdensome for the investor or too risky for the service provider would be ill-advised. It will incentivize investing in risk-free products or, at the other end of the spectrum, in dubious products, none of which. In order to avoid such risk, the sustainable readability of financial products should be improved. For example, greater clarification is needed of how sustainability preferences as collected or targeted by financial service providers and insurers are linked and coordinated with product definitions set by SFDR. On one hand, one is expected to ask the client if, how, and to what extent sustainable finance instruments should be integrated into his portfolio, and on the other, one has financial products promoting environmental or social characteristics, the so-called Article 8 products in the EU jargon, and those targeting sustainable investments, the so-called Article 9 products. How these different concepts interact together needs clarifying. In the short term, the European Commission should provide answer to the many questions raised by supervisors and market participants. In the longer term, in my view, is what it will be inevitably we will have to introduce minimum standards for sustainable products to make sure we can effectively prevent greenwashing as originally intended. We also need to obtain more clarity from providers of ESG data, ratings, and services on their methodologies and how they manage their potential conflicts of interest. Together with our peers at the IMF, we call on the Commission to address this regulatory vacuum as part of its renewed sustainable finance strategy and to propose a mandatory framework for these providers. Turning to digitalization, the same complexity rapidly arises since the requirements contemplated for the financial industry in the EU with DORA, MiCA, and the pilot regime need to be coordinated with the more global framework of the digital services package. The dividing line between electronic money tokens and asset-referenced tokens is indeed fine, and the separation between asset-referenced tokens and tokenized financial instruments is vague, considering that there is still no common definition of financial instruments across the EU. The articulation between regulation of instruments and regulation of service providers is complex, and the neutrality vis-à-vis technology is tricky to implement. Furthermore, the case of a platform that is at the same time a social media and a trading platform should also be covered. Finally, there are too many competent authorities in the EU, national and European, for activities which are largely similar, whatever the financial sector or the national location. We all know that when the regulatory and supervisory framework is not homogeneously applied, the passporting of services is generally a risky exercise. Coming now to my second point, the risk of having either a too lax or a too late regulation, which means that we would miss our goal, or an ambitious but too European-centric regulation, which would be detrimental to the competitiveness and efficiency of our financial intermediation. With regard to sustainable finance, the possibility to have directly international standards instead of European standards would appear most appealing. After all, European large companies would warm to the idea of being on an equal footing with their third country competitors and of avoiding the burden of delivering multiple disclosures according to standards that are specific to some jurisdiction or promoted by some large institutional investors. Likewise, and understandably, all institutional investors would appreciate making their own sustainability assessment based on a single set of international standards. With a change in the US stance vis-à-vis sustainable matters and the proposal by the IFRS Foundation to develop sustainability reporting standards, there is a set of common standards. That this said, some could nevertheless argue that this opportunity is just an illusion. The proposal focuses first on climate and financial materiality, which is not sufficient to meet EU objectives and level of maturity on these matters. Furthermore, since it would not be acceptable to just adopt the prototype proposed by the Alliance of Private Standard Setters, it could take long for delivering just a small set of standards. Indeed, the EU is already well underway with CSRD and the new mandate given to EFRAG. The temptation to slow down our work while waiting for international standards would thus be a huge mistake. Obviously, we should find a middle way and progress in a coordinated manner. For Europe, this means contributing to the international standards, which could serve as a baseline, while developing a broader, more ambitious framework encompassing all ESG pillars and double materiality. Since sustainability standards are also largely sector-specific, a common sectoral breakdown should be thought at international level. Let's try to achieve this. In my opinion, IOSCO, the International Organization of Securities Commissions, could be instrumental here. There is a similar trade-off in the digital field. One could consider that currently in the EU, the largest and most critical service providers are third country corporations. To a large extent, the competitiveness and efficiency and sometimes the security of our industry depends on the recourse to these external service providers. Nevertheless, to be highly dependent upon them is a dangerous situation for our financial industry. That will represent a weakness with financial stability issues at stake. A more balanced framework is therefore necessary. Basically, with the DORA proposal, the constraints would, however, mainly be placed on the financial industry when it comes to using the services of information and communication technology third-party providers. To some extent, this would assume that our financial firms have strong negotiating powers when negotiating their contracts with large non-European critical service providers. It is actually unlikely, even if the single market is an important part of the business development. I believe that we should carefully rebalance the envisaged requirements, make some contractual clauses mandatory, impose that contracts be signed with an EU-located service provider, and expand the ESA's sanctioning powers. In both fields, sustainability, digitalization, we are well underway to build an appropriate regulatory framework fit for the coming decade. Within this framework, European exchanges will find the new opportunities to play the full role in the sustainability transition and the digitalization of our economies. This will enable the innovative businesses and unicorns that have grown with private investments to reach the scale they need and achieve their long-term objectives. Public exchanges are also given the chance to innovate with the pilot regime for blockchain technologies. They are uniquely positioned to benefit from and contribute to the growth in green and sustainable finance, thanks to the advance of the EU regulatory regime. Therefore, let us finalize it without lending undue complexity, whilst keeping the competitiveness of our financial industry in mind. And I will stop here and thank you for your attention.
No, thank you, Robert. And I think that was a great navigation to the complexity of trying to get the ESG reporting right and avoiding certainly the EU-centric regulation. I think what you said to number one, make, I think this, the baseline international, but certainly develop more ambitious standard European. I think that's the way we go. And I think we're very much in favor of that also, not to constrain the solely unlisted companies. And I think make this a broader effort is extremely important. ESG is not about listed or non-listed, as you said. It is about the entire economy. So thank you very much for your contribution.
You're very welcome. Bye-bye.
Thank you. That brings me to our last panel right before the De La Vega Prize today. And it's called Fostering Innovation to Drive the Next Era of the Economy. And it will be moderated by my colleague, or I would even say my partner in running FESE, Rosa Mesto. who not only skillfully steers the policy work of FESE, but who also will steer us through the final panel of the day. The floor is yours, Rosa.
Thank you very much, Rainer, for your kind words. Good afternoon, ladies and gentlemen. It is a pleasure indeed to moderate the last debate of the day on the digital transformation. I think already today this topic has been touched and slightly discussed on a couple of occasions. So it will be really an excellent opportunity now to go a little bit deeper in such a passionate area. The future of finance is digital, and the exchange industry has been at the forefront of innovation and has made use of the transformational opportunities already for many years. As you may all know, last September, the European Commission adopted a digital finance package, including legislative proposals on crypto assets and digital resilience. In fact, discussions on the markets in crypto assets, the so-called MiCA file legislation, are getting started in the European Parliament right now. But digital is a very broad topic. Even climate change could be a sticking point in discussions with regards to how much energy is needed to develop and run these new digital assets. Digitalization can provide easier access to capital markets at a lower cost, but also these changes are bringing some risks. Europe needs a framework that empowers retail investors to take the right decisions and protect them, offering trust and encouraging them in participating in capital markets. Digitalization can provide easier access to capital markets at a lower cost. But again, we need to really be very mindful in striking the right balance. This is why at FESE we advocate for regulation that safeguards the principle of same activities, same risks, same rules. And in fact, I was pleased to listen to this morning to the Minister of Finance in Slovenia, who echoed this concept and also confirmed that digital finance package will be at the core of the priorities for their upcoming presidency. Without further ado, let me welcome our distinguished panelists that are here with me today, and I'm very pleased to introduce them. From the European Public Authorities, we have Jan Seysens, Head of the Digital Finance Unit at DG FISMA in the European Commission. Hello, Jan. We also have today with us Eero Heinäluoma, Member of the European Parliament and Shadow Rapporteur of the MiCA file for the Socialists and Democrats.
Hello and good afternoon.
Hello, Eero. From the market practitioners' side, I have the pleasure to welcome Bjorn Sibern, President of European Markets at Nasdaq. Hello, Bjorn. And also Matthias Wockel, Chief Operating Officer at Börse Stuttgart. So first of all, thank you all. Hi, Matthias. Thank you all for being here today. And I would like to start with the public officials, because I think we all would like to hear and understand how it is to approach legislation to the digital space, being this such a fast-growing and moving target. And I guess this might not have been an easy task to go through. So I would like to start with Jan from the European Commission and hear from you how can the European Union legislation provide for a regulatory level playing field which strikes the right balance between innovation on one hand and then investor protection and market integrity. The floor is yours, Jan.
Yeah, thank you very, very much, Rosa, and for putting this topic on the agenda today, and looking forward very much to the exchange with all of you. Indeed, this is not an easy topic, and actually, I think we should probably have started looking at the market developments the other way around. I mean, this is for once an area, I would say, where the markets were started to be there first, and then comes actually the regulation. But of course, we know at some point, basically, markets can develop. They can, in sometimes areas, fit into regulation. But at some point, probably there needs to be legal clarity and also common framework for those markets to further grow and actually also mainstream. And I think that's what a bit we are working on from our side to make sure that Europe actually has a common framework, a common approach on those matters. So I think that's the very first clear line we have. The agenda of digital finance is by definition cross-border. Many of the solutions can only be developed, can only be profitable if they are developed not just for one member state, but for many member states. So we need to look at this together at the European level. Secondly, digital finance is finance, but it's also part of the broader digital agenda. And I think one of the key novelties maybe of the digital age is actually that the boundaries between different sectors or parts of the economy, different actors are actually more and more blurring. That's why from the European Commission side, yes, we have put a digital finance agenda on the table, because digital finance is still finance and it needs to be regulated as such. But this is very much part and parcel of a broader digital agenda, which the Commission is pursuing to make Europe fit for the digital age. And we are working from our side, actually speaking a bit about my own work in DG FISMA, working on digital finance. This is really only half of this is about working on financial regulation. I think the other half of it is about kind of working with the colleagues in DG Connect and in other DGs actually on the broader pieces of legislation they are actually preparing to make sure that indeed the perspective of the financial sector is well represented. And I think that's also one of the answers to your very valid and important issue. Indeed, same activities, same risks, same rules, and that needs to be applying within sectors, but also as indeed operators are crossing the boundaries of sectors, that's where it needs to apply as well. So I think the last challenge which we have is here indeed, as always, to find the right balance indeed between regulation and innovation. I think that's what Ophèle already referred to also earlier on. We shouldn't make it too complex. We should also not regulate things to death which don't even exist in Europe before even seeing whether maybe they can be, let's say, brought to productive use. This is why we try to actually also come with a pilot regime which tries to open a bit the possibilities within very small, limited boundaries actually for certain activities which otherwise may not have been possible. So that we can find this balance. This balance, however, does not mean actually that you do not regulate digital, because indeed the same activities, as soon as they are coming into the framework, need to be regulated as such. So I think those are a couple of the points we are having: balance between regulation and innovation, looking clearly across sectors, and thirdly, indeed, having clearly a view or a kind of a focus on the different parts of the financial sector.
Thank you very much, Jan. And indeed, in fact, you touched on a very important point, which is the fact that digital is one piece of the puzzle. Indeed, digital in general is huge. So indeed, finance is obviously our core now, but obviously needs to be put in prospect. I would like now to turn to Eero. Welcome again, Eero, and ask you how is the European Parliament, but concretely Econ Committee, contributing to legislate the digital transition in financial services? For instance, I mean, artificial intelligence is something that is being used to run more sophisticated market surveillance that can be applicable on many instances. So what is the view that Econ is taking to approach this very fascinating file?
Thank you. Thank you very much, Rosa. And may I thank also for the organizers for inviting me to this panel, and congratulations to FESE for this high-level and important event. I have to say that this is a big team here in the Parliament and in the Econ Committee. We have a special working group for fintech area, which has been very active during recent 2 years, and then Parliament already accepted its own initiative report on this theme last autumn. And now we are looking at the MiCA file, the proposal of the Commission, and this day is a nice day because last evening it was the last possibility to make and table amendments to the Commission proposal. myself, I signed 190 amendments, and altogether there are nearly 1,000. So it will be a huge job for the committee to find agreement on these amendments and on the Commission proposal for new legislation. However, it's worth of mentioning that in the Parliament there is very much, I would say, good atmosphere in this field. It seems that this discussion is more uniting than dividing, and people in the Parliament are in favor of the new innovation, but there is a very strong feeling here that we have to have a good protection of investors and to be sure that the markets can do their job in a proper manner and have a good regulation on the basis of the activities. There are some remarks which I would like to make here. The first one is that I'm pretty sure that there is really room and importance for the public exchanges also in the future. They will have a key role to play in completing CMU and in this way increasing welfare. I was especially delighted also to hear the Commissioner's strong support to make the financial sector more sustainable. This is something which is, I would say, the nature of this Parliament, that nearly in every session this is one of the important themes. And then I welcome also the commitment of the Commissioner to tackle the problem of indictments and lack of transparency, because I believe these are clear obstacles towards the access for more retail investors, which is in the interests of all of us. Then concerning digital finance today, as I said, there is strong support for going forward, strong support for new innovations, but at the same time there are a lot of worries, and of course they are coming from the recent news from the crypto world, which demonstrate again that there is need for better rules. And what is interesting is that we can see that the same worries are also, you can see them in USA, and the new Biden administration is ready for cooperation in this field, which gives us some possibilities to have also joint rules and joint principles when we are going towards the new world of digital era. I'm coming from Finland. I have to say that I'm a strong supporter of innovation, which makes financial sector more efficient and effective. This is of course the benefit of the consumer also, and blockchain can have a place here, there, no doubt. At the same time, we have to be very careful, and this is also quite much the atmosphere in Econ Committee. And I think it's important that we don't go in the name of innovation on a path of deregulation, because that's something which is not needed now. Of course, when I'm talking about concerns, we have all noticed the risk of bubbles here, and this seems to be inflated. And when we still remember the problems from the financial crisis 2007, 2008 and afterwards, we have to be very careful that our regulation is in good shape, so that it can be one factor in preventing these risks to come really true problems of our economies. So I would say that I'm pretty optimistic that after some months and after hard work, we will have a broad majority supporting the MiCA file, but we must be ready to make some more clarification to the Commission proposal. And one example is that we want to make clear which entities from the crypto world need to be considered as obliged entities, and this it must be in line with the latest FAT findings, because the anti-money laundering is one of the big themes also here, and we hope that the new legislation, the MiCA legislation, also will be one part of the resolving the problems of money laundering. So we are here waiting also the anti-money laundering package from the Commission coming to the Parliament next weeks, and I think that this MiCA file can be the first step towards stricter rules preventing money laundering. So lot of possibilities now, and what is good, at least in the beginning of the work, that there is a good atmosphere and possibility for joint efforts, and this is one of the big topics for the Parliament this year. Thank you.
Thank you very much, Eero. I definitely think that listening to you and Jan, I have a feeling that we are really in good hands when it comes really to go through in this a very important area to regulate the digital finance space. And as you were saying, there are many aspects that need to be looked at. But I would like to turn now a bit more into the innovation. I think you were saying that indeed coming from Finland, you very much support that. And I also think that it is very important to look at the advantages and opportunities that we have there. And I would like to ask Bjorn from NASDAQ, if you could please tell us a bit, what are the drivers of new technologies in the exchange industry? You come from a very technological company like NASDAQ, so I'm sure it will be very interesting listening to you.
So thank you, Rosa. And first of all, yes, NASDAQ is a technology company, so that's one of the key things we focus and spend a lot of time on, and we provide technology support for the financial industry. Probably goes without saying that new technologies have had significant impact on the evolution of the financial industry. New technology has changed the way customers interact with market infrastructure providers like us. Technology developments in relation to data analytics, mobile technology, cloud computing, machine learning, AI, and blockchain opening up new possibilities in relation to service NASDAQ users and provide solutions to our customers. I think if we just take one step back and think about the evolution of the markets, and this is not credit to NASDAQ, this is actually credit to the industry. The fact that we have millions of retail investors now sitting at home with easy, cheap access to the financial markets. The fact that they have now the chance to invest in SMEs, new upstart companies, in a transparent, fair, democratized way is very important, and something I think that the industry should take a lot of credit for. Of course, there should be the right rules and regulations around it, but the fact that we can turn retail investors from savers into investors is something that I think the industry should be proud of. And a lot of credit is not so much to the exchanges. We provide the fair and transparent market, but it's actually to the banks and brokers who have built innovative solutions, helping the retail customers getting cheaper and easier, transparent access to the market. But let me then turn to a couple of examples on what we do within NASDAQ. And this is, you touched upon it also, around surveillance, market surveillance. So we run surveillance systems. We have done it for many, many years. We use surveillance systems for our own exchanges. We sell surveillance systems to other exchanges, other regulators around the globe, sell-side and buy-side firms. For us to develop and be more sophisticated around market surveillance, we use AI and machine learning. Simply, if you take our surveillance team in each of the market we surveil, they get thousands of alerts every day. Thousands of alerts every day. We use machine intelligence, AI, to help managing all the alerts to make sure we are smarter and better, get the right alerts, focus on the right alerts. So I think using AI and machine learning help us every day become smarter, better when we surveil our markets. And the job has not become less with more retail participation, high frequency firms sending massive orders to the exchanges. I think actually the use of AI has been more important than ever. And of course, we benefit from being a technology company. We benefit to have probably one of the most sophisticated systems in the world. And of course, so it's not only development for our own exchanges we do, it's also something that benefits the many companies, corporates out there that buy our surveillance. So I think that AI, machine learning is very important. Let me also touch upon cloud. The way things are today is that more or less every exchange system for most sits on-prem, so in a data center. I think actually the opportunity to use cloud in the future will be significant for the whole industry. It will make it easier to get access to data. It will make it easier and cheaper for different type of customer segments to get access to data. So I think the cloud will have significant impact on our customers, but also the way we run our markets going forward. If you look at the volatility we've seen during last year, our ability to have a scalable setup, also using cloud for some parts of our offering, have helped us in a significant way. So cloud will be more and more important. It is a journey. It will take a long time, but it will make it easier, better, and cheaper for customers. And it's exactly help us making sure that we have an even more robust system. So I think the idea with having everything on-prem in a data center, I think that will change over time. So also cloud will play a very important part of the future journey and around innovation. But let me pause here.
Thank you very much, Björn. I think it's probably for our audience very interesting and important to listen to these developments, because that really shows that an exchange is not only offering primary listings and also the trading facilities, but as well, you know, is really innovating a lot on all the advantages, as you were mentioning, for instance, on market surveillance and helping retail investors to really access the capital markets, being this one of the objectives that we heard this morning from the Commissioner McGuinness. Now turning to Matthias Volker from Börse Stuttgart. I also know that Börse Stuttgart is quite active in this field, and I would like to hear from you how can the digital finance package for crypto assets, MiCA, support innovation while address risks? Because I understand that this is something that at your house you are working a lot.
Yeah, thanks a lot, Rosa, first of all, for giving me the opportunity. And indeed, Börse Stuttgart, it's probably fair to say that we are one of the front runners when it comes to crypto and digital in the sense of tokenization. In fact, it is so important for Börse Stuttgart that Börse Stuttgart changed its governance and separated the businesses into the traditional business, which is called Engine 1, and the new digital business, which is called Engine 2. To, in the future, stand on these two pillars, right? And I think that is already a reflection on how important that topic is for our house. So having said that, when I say digital, I mean tokenization and cryptocurrencies, where Börse Stuttgart has been quite active and come up with a number of innovative offerings. And these offerings circle around a retail offering around crypto, but also an MTF for crypto assets, as well as a crypto custodian, as well as a tokenizer. So basically offerings across the entire value chain. And for us at Börse Stuttgart, it is of course extremely important that there is this regulatory framework based on the principles, and I think they have been mentioned already, and I still want to repeat that, based on the principle of soundness, fairness, so same rules for the same kind of activities. And we believe it is absolutely key that we have this clear legal framework, and that there is also a clear definition of what a crypto asset is and what it is not, and how it is treated and how it is not treated. And if we do this right, and when I say we, I mean the regulators, but also us as market participants, I think Europe really has a chance to establish itself in this field, also on a global level. If we do not do it right, there will be other players, less regulated, more fraud prone, etc., stepping up, basically offering the platforms, but at lower standards for both retail and also institutional customers. So we are fully supportive on a sound regulatory regime, which ensures that there is players that guarantee market integrity, that guarantee security and investor protection, while on the other hand, not crippling this new business. And as some of you know, or might know, before I joined Börse Stuttgart to run the digital business, I was with McKinsey, and I also served a lot of players outside Europe. And one pattern I recognize is that Europe is very good at coming up with almost a perfect solution which works great on paper. The US and other parts of this world are very good at being where the market is, being where the momentum is. And unfortunately, oftentimes these solutions in the end prevail. They might not be perfect, right? But then there is so much momentum, there's so much talent, there's so much money, there's so much connectivity, there's so much technology. And at the end of the day, you might have a perfect solution, but the music is playing somewhere else. And I think this is the situation we now need to avoid. We need good, sound, business positive and investor protection regulation now, or as early as possible. And then I'm very positive that Europe can play a very, very good role, and not only for Europe and as for European customers with this isolated mindset, but even I think we have here now the possibility to position Europe as one of the forerunners also globally in this new technology.
Thank you very much, Matthias. Excellent observation, because indeed, I think everybody in this panel will agree that we want the music to play here, not elsewhere. Yes. So I'm going to now turn to Jan from the European Commission, because I would like to understand from you the challenge that is regulating these new areas while interacting with existing regulation. And I will give you a concrete example. For instance, right now, the European Union sets the approach in capturing certain crypto assets, such security tokens, in existing legislation, as could be MiFID, but other tokens, like payment tokens, are in the bespoke MiCA regime. Do you think that the framework that we have now, or we will have in the future, I mean, once we have MiCA agreed, will provide enough clarity and regulatory certainty to the markets? Because I think we heard to the practitioners all the opportunities and the things that could be done and the use that is there. But at the same time, of course, from a compliance point of view, it is important to have the clarity. So how are you looking into this twofold subject?
Yeah, thanks. I think this was indeed one of the biggest challenges when we actually tried to put up this proposal. How do we, I mean, the starting point are, of course, our existing rules. At the same time, we have a whole market out there which is today completely unregulated. So what MiCA does is actually it brings for the first time regulation into a space which today is indeed largely unregulated. A few member states have put national laws on certain aspects of it, but many aspects are indeed also not subject to regulation. And so I think there could have been several approaches. We could have said, yes, let's just expand the scope of MiFID to everything in this area. I think that could have created the risk. I think some of the elements we're looking at are actually pretty far away from financial product instruments as we know them today. And I think in some areas, so it could have created the risk that we are going a bit above the top, that we all know that MiFID is not a, let's say, light touch regulation. It's in terms of compliance burden can be quite challenging. I think it is the right approach, but for financial instruments. But we thought, okay, maybe for something which is today completely unregulated, we need to start with a bit more proportionate rules, and I think that's the proposal of MiCA. To make sure indeed that and I think with MiCA we have a chance for it, that the regulation is conservative, solid, but at the same time also is not so kind of compliant intensive that people will then continue to prefer the unregulated space. Because let's face it, in the crypto assets area, it's not something where we can control all our citizens and monitor that they do not from their private computer access actually assets or marketplaces outside Europe. I mean, that is not a control we have today, and that is not a control we'll have in the future. because we are not China, basically, who surveys, does a full surveillance state about all their citizens. So we need to be aware that these possibilities exist, and that's what we need to take into account. I think in that sense, MiCA is the attempt, and I think it can be successful to actually have sufficient safeguards while not having too much compliance burden. Now, and sorry, I was now a bit long, but I think that's important to start the discussion. The question is then indeed, how do you interact this with the traditional MiFID rules? And I think on our side, we have opted there for a clarification. We have opted for a clarification of MiFID that's very clear to say if a financial instrument is based on distributed ledger technology, it still is a financial instrument. It is not just the technology which changes it, basically. That is maybe, you can argue it is an obvious statement, but in the actually application of MiFID in member states, it's not always so obvious. So that is a clarification we are proposing in the legislative proposal we made with MiCA. And then we were also reflecting, do we need to go into more detail? Do we need to have in detailed catalogs of instruments which would be covered by either the financial instrument definition, so MiFID, or by MiCA? I think our conclusion was that this would not be the right approach, because we may well be able to have a perfect taxonomy of the instruments that exist today. But this market already, when MiCA comes into force, will look completely different than now. So our suggestion here was actually, and that's also maybe one of the things which is maybe different when regulating innovation compared to more traditional markets. Actually, we said let's keep the principles clear legislation, and then let's indeed make sure that the supervisors have sufficient guidance, that the supervisors work together. I think the Commission can do its bit with some legislative interpretation. The European supervisory authorities need to do their bit there, and that's I think also where the co-legislators are going right now. Rather than having detailed 3, 4, 5, 6, 30, 40, 50, 60 pages of detailed rules classifying the instruments of today, rather to have a process which makes sure that we'll have convergence, that we will not have different rules applying, that something will not be classified as a financial instrument in France and as a crypto asset in Germany, but that basically these things converge. That's the approach we're having there, and we hope that this can be actually also successful.
Thanks very much, Jan. And indeed, the supervisory role will be absolutely critical in that area, as you were saying, because indeed does not make a lot of sense to regulate very, into the details on something that is so fast growing and moving that by the time it comes, it's already left. I would like now to turn again to Matthias and really understand your views from a practitioner point of view on the actual DLT pilot regime, whether you think is fit for purpose. Because, I mean, following discussions in there, while it really allows for the sandbox and really like the test of really proving some of these innovative technologies, at the same time, it is very important as well to make sure that we keep this same business, same rules. So, Matthias, I will be happy to hear your views about the DLT application. You are on mute, Matthias.
Okay, very good. So, first of all, thanks a lot for calling me a practitioner. It's my first day at Börse Stuttgart, so I'm starting.
But you have a past. You have a past.
I have a past. I do have a past when I really looked into these things, and maybe on DLT or crypto in more general, right? And I think that's another message I wanted to say, and I think it's in line also with your question, is when I look at my past, and 3 years back, I looked at DLT and tokenization on one hand and cryptocurrencies as almost two separate worlds, right? And I thought that tokenization, that is probably in the mid and long run the future of capital market infrastructure, and Bitcoin and the other cryptocurrencies are asset classes, just asset classes, right? And that was my thinking, and that you could keep these words apart almost, right? And be quite strict on cryptocurrencies, for instance, or less strict, and be very open and foster DLT, etc. but I've also, I think, maybe not grown smarter, but grown in experience. And I realized that these two worlds, they really strongly interact. And I wanted to build also on what has been said on the vision for Europe, on what you just said, Jan. I think that's a very important point. There is now these huge US players having IPO'd, right? And they're focusing a lot on cryptocurrencies. On the other hand, these players now have the network, the brain power, the talent, the reputation, the brand to also, and the technology, right, to also go into DLT. So, and in tokenization. And they can do this with very, very deep pockets, right? So whenever we talk about also tokenization or DLT technology, I think we need to really have this broad perspective and say it has an element which is, call it Bitcoin and Co., which is very hot. There's a lot of movement, there's a lot of trade, etc. It also has this other element, which is around tokenization of financial assets, of non-financial assets, which is more a mid and long-term play. It has started now. It's a long and mid-term play, but fundamentally, these two things belong together. The public perception is one that looks at them as a very integrated thing. Talent goes there. It goes to crypto DLT. There's not much differentiation. And also, Börse Stuttgart looks at it in a very integrated way. So having said that, now when it comes to DLT regulation, specifically, I do think the objective should be, again, of regulators and of market participants to make both financial assets and non-financial assets available via blockchain technology. There are a number of very promising use cases in areas where there is less liquidity, less blue chips, etc. Right, and I think this is also where it happens. I see it in corporate bonds. I see it in syndicated loans. I also see it in other debt instruments, and also mid and long term in equity. Plus, I see it in non-financial assets, be it real estate, NFTs, non-fungible tokens. These things, I think, will come. 5 years back, a lot of people would have said they will be here in 2021. They're not. Oh, no, they are, but not at scale. But now it is gaining momentum. And what I realize is also, again, from a talent and cluster perspective, this is now such a hot space that so many smart, innovative people who want to do the right thing, and basically parts of the best talent of Europe look into it, that it is almost like a momentum in itself or reinforcing itself. So long story short, I do think that in 5 and 10 years from now, a lot of asset classes will be partially digital. There will be some asset classes that are overly digital, and there will be asset classes that are not too digital at all, where the old system works quite well. Bitcoin, the cryptocurrencies, will be a catalyst, a commercial and talent catalyst for this environment or for this development. And if we have this target picture in mind, from there on, we should then look, okay, what does it take to make people and enterprises in Europe successful in getting to this target picture?
Thanks a lot, Matthias. And I would like now to turn to Eero, also in your role as shadow rapporteur of MiCA, whether you want to react to some of the statements made about the crypto functioning. But also would like to ask you, Eero, what are your views on the digital euro? And in particular, when assessing how to ensure the balance between protecting the privacy while also addressing the anti-money laundering concern. So I think you are a member of European Parliament, very much into the safeguards against money laundering in the new markets. So it will be very interesting to hear your views about that.
Thank you, Rosa. And so if I may continue the previous speaker and his idea, I have to say that I very much agree on his big picture, on Matthias' big picture, that the scenery is now narrowing in a way, and all the phenomena are there, and we have to have a joint approach to be effective and to get our aims through the legislation also. So I would like to perhaps take one more point in this discussion, and that's the environmental side, because this is a complexity and also some conflicts here. You know that the EU is now doing a lot for this Green New Deal project, and the governments all over the world are doing their utmost to cope with the problems of climate change. And we know that governments around the world, they have spent billions on subsidies for supporting the electric vehicle shift. And if you think all together, all the electric vehicles combined globally, they save around 52 billion metric tons of CO2 annually. And then at the same time, if we look at the Bitcoin, it has more than completely negated these gains, so more than 50 million metric tons of CO2 annually. So this is not only a financial question. Of course, this is the interest of this conference and discussion, but we have to be consistent here. And this means that this will be one of the discussions on MiCA file also, that how to make sure that this like Bitcoin stablecoins, they will not mean that we are having new technologies which we are saying that they're innovative, but at the same time they are destroying the nature and creating huge problems which we in a way have to compensate in the later phase. So this will be one discussion here. Then concerning the rules and how to make sure that they are really abide and they are effective, I think that we have to give a greater role for ECB here and also greater role for ESMA, and this will be discussed in the MiCA file, that which kind of rules we need so that we can hear the expertise of our central bank and also ESMA, which is a highly competent authority here. So then concerning the digital euro, that's something where we are eagerly waiting here in the parliament. We have been encouraging the ECB to go further, and we are very happy to hear the latest developments that the ECB is now doing its work. I have to say that I trust more on ECB than on Facebook here as an issuer of a currency. And so there is some really positive things when we are waiting the digital euro to come. It will mean a safer, faster and cheaper payment system. And what is time from the perspective of individuals is that the digital euro is not sharing your personal information to commercial companies, so you can use digital euro in total privacy without that this is a good for making money for giving this information to other companies. But at the same time, after discussions and hearings in the Econ Committee of the ECB experts, we have to manage our expectations. It seems so that this will take time before we can see the euro, digital euro. It will not be a revolution, rather an evolution, and it will take years. And then we are knowing that also the plans are, you could say, quite conservative ones. If there will be quite small amounts of money which people can use in digital euros, there has been discussions about some thousands of euros. It will not totally change the concept of payment system. So and it will not be any kind of threat, for example, for the banks. But the privacy focus here is an important one, and the ECB is totally taking this into account, that they are doing the practices and planning it in such a way that we can trust that the privacy of people is respected. Then concerning the money laundering aspect, I'm afraid that at the beginning of this process, if the amounts of digital euros used are so small, it will not have a great effect on money laundering, anti-money laundering activities. So it means that we must be ready to tackle the money laundering problem in other ways, which means that there are huge expectations for the Commission to launch a new proposal for the money laundering regulation, and also to look at there are enough resources for observing the sector, and for there is support for independent authority on this field for the whole European Union. So I suppose that the digital euro will be a reality, but it will take some years, 5 to 6 at least, and then we can see already now that, for example, outside the Eurozone, Sweden is ahead of us, and then of course China is a lot ahead of us. So in this field, Europe will not be the front runner, but hope that we will be the second one, at least in taking the use of digital currency.
Thank you very much, Eero. And now I would like to turn to Bjorn and move a little bit from what we have been discussing, because it is clear that we're in a momentum of data-driven finance. And I would like to get your opinion on the data sharing rules. I think this is touching many aspects in the financial sector. So I would like you to please shed some light into the principles that need to drive this topic.
Thank you, Rosa. So the finance industry is for sure a data-intensive industry. I think what people sometimes fail to recognize is that if you look at equity trading, it is standard data. It is data that you have historical data. It's easy to consume. If you take back to the retail investor story, a retail investor can sit at home getting access to data. For €1 a month within Nasdaq, you get access to real-time data on shares in your portfolio. That's super easy. Then you have more complicated data, and we also try to cater for that. That is alternative data where you do not have the history, you do not have the same transparency. That's a part of the journey where actually we acquired a company called Quantal that sits on alternative data that helps more sophisticated investors doing smarter and better investment decisions. So I think actually when you look at the industry, you have alternative data, very difficult, less history, no standardization. Then you have equity data, that's super easy. And then you have something in between. There's a lot of discussion around ESG data and the need for more standardization around ESG data. So I think that's one of the key things I just want to mention and highlight here. And fixed income data with also sometimes less transparency around the data. But I think what is important, and that is what we as an exchange is about, to create transparency, equal access. So what is important for me is that investors should have the same access to data if they're willing to pay for it and want to have access. And of course, a retail investor have a totally different need versus a highly sophisticated bank or a high-frequency firm. So of course, to make sure that you need to get the equal access to data is very important. Part of what we do. I think one of the challenges is, and we heard it earlier today around the consolidated tape, is in some areas, and also on equity where we have a long history on data, is that it's not possible to get the full picture around how much is traded in let's say a share in Germany, because you do not have full transparency. So the idea of building a consolidated tape post-trade where you have all data, not only from the exchanges, but all the MTFs, and other venues is important. So I think actually what we work for and what is very important for us as a part when we look at data is equal treatment, transparency, non-discriminatory access to data, and of course understanding there are very, very different needs. I think a key part of us running a market is that you have a market that is for retail customers, that it's a market that is for institutional customers, it's for local customers, it's for international customers. And to build a market that covers all of that with different needs is difficult, but to give them equal access for the data they need and what to pay for is very important. And I think that's my key takeaway around the data. And again, remember, equities is easy, it's relative standardized data, and you have historical data, where you have many part of the financial industry where you lack data, lack transparency, which makes it much more difficult and much more expensive for investors to invest.
Thank you very much, Bjorn. And now I would like to kick off quickly the last round. We are a little bit behind schedule, so we will really need, please, to be concise. But I would like to quickly move to the European Commission. And just one fact, we do not have a European cloud yet. And we heard from our colleague Bjorn on all the good aspects that the cloud is bringing to really facilitate access to capital markets, also the functioning and the innovation. Do you think, Jan, that the European Union should facilitate its own cloud provider to remain competitive? And I need to say that this was a topic which was quite discussed at the Capital Markets Union high-level forum from a competitive point of view of the Union. So what's your view on that?
Yeah, I think what we need a cloud environment which is first of all well supervised, and it's clear that authorities can have the confidence that they have access, basically. And secondly, I think we need an environment that is not prone to concentration and to concentration risk and possible monopolies or, let's say, oligopolies. That's very important. I personally hope very much that also in the future European providers will play a stronger role in this. And I think the Commission, with its work actually on a European cloud environment, and indeed the work which member states are carrying out with Gaia X, I think brings us in that direction. I think strengthens the European capacities as well here. I think that's very positive, but we're probably not quite yet there. And this is probably a broader issue which goes a bit beyond the financial sector. So I think, given that's the case, it is important that we indeed focus also on the policy objectives of having indeed a clear and strong and coherent supervisory framework, and indeed a clear monitoring of concentration risks.
Thank you, Jan. Moving to Bjorn, because Bjorn, Nasdaq is a transatlantic exchange, so you have obviously the experience in the US versus in Europe. Do you think that DORA in Europe is fit for purpose when it comes to cyber and the cloud?
So let me start by saying that cybersecurity and resiliency is something we spend a lot of time, money on. I'm glad to say that the last year's time with a lot of volatility, and by the way, also this year, and many other exchanges did the same. We kept our markets open, running, despite the volatility, despite the record in number of transactions, despite the number of records in orders. So I think actually that was a key part, and I think that is something that we are proud about. We benefit, and I think the whole industry that handled the volatility during last year in a very good way. We benefit here in Europe, Nasdaq here in Europe, from being a part of a big organization. So what we do around cybersecurity, what we do around resiliency, that is cost, that is information sharing, that we work closely with our colleagues in the US. So being a part of a big organization helps us a lot. If we would have been a standalone exchange, small exchange in Europe, it would have been very, very costly or very, very difficult to run the infrastructure and the cybersecurity setup we have today. So I think that's very important. Just turning quickly on DORA, regulation is not a silver bullet against system issues, but it can help putting the right framework in place. So I think actually DORA is a good starting point. It's good with the regulation, but it's not a silver bullet. But let me just end here, in interest of time.
Thank you very much, Bjorn. I have one question from the audience that I would like to take briefly, and probably is either for Jan or Matthias. And it is in fact quite straightforward. Do you think that the Bitcoin should fall under MiFID or under MiCA? Any of you that you feel like taking it?
I mean, given that about regulation, I think probably it will be either for Eero or for me. I don't think this Bitcoin is covered by MiFID. To the best of my knowledge, no member state in the EU would actually classify it as a financial instrument.
Thank you. Matthias.
And maybe adding that, and also to my prior point, if you also look at Bitcoin also as an instrument or a transmission belt when it comes to innovation in the broader blockchain or DLT space, I think it makes sense not to completely also cripple it in Europe, because others will offer it and others will trade it. And these others, if they're not European, these others will then also venture into Europe when it comes to the broader blockchain technology. And I mean, you mentioned cloud. You know who the cloud providers are, right? And let's not fall in the same trap when it comes to the crypto technology here in Europe.
Mm-hmm. Thank you. Okay, so I think it's time to wrap up, and I would like to give the floor to Eero for the closing remarks. Eero, please give us your final thoughts.
So thank you very much. This has been an inspiring and important discussion, and the whole team of the conference, very useful for all of us. I suppose after this panel and also after this day, it's quite obvious that there is a great need for stable and balanced regulation, and that's also in the interest of the business. Europe ought to be a front runner in digital financing, and we have all the possibilities to do it, but at this point, this is not the fact. So a lot of things have to happen, and one of the real important thing is that which the Commission and the Council and the Parliament must do its work is to have a stable and balanced regulation, and that is what we are now doing. And then I suppose all of us can accept the basic principles presented today here. So from your side, some same activities, same risks, and the same rules. And that's the aim of regulator here. Then concerning the last discussion on the clouds, I have noticed that nearly in every area we are now discussing about the strategic autonomy concept, and it's really difficult to see how we could have this kind of strategic autonomy without having our European cloud system. So I sincerely hope that this will be a joint effort to create abilities for the companies in this area to take all the use of European cloud in the future. Many thanks for the organizers, and pretty sure that this discussion will continue, and the Parliament is ready for cooperation, and I sincerely notice that it's important that we are doing these decisions together, and regulators are listening the experts and also the business people who have the knowledge from the real life, and who know the recent developments, what is happening in the financial sector. So many thanks for you, and ready to continue our cooperation.
Thank you very much, Eero, and very true. I think this is indeed another example of where cooperation needs to come from the two sides, the policymakers on one side and the business reality and business practitioners. So I really want to thank you all. I think it has been a very fruitful discussion, noting that, as I said at the beginning, digital is really multi-component. There are many things we could have been discussing even for more time ahead. Now we need to finish. So I really would like to thank you, and hope to continue discussions in the near future. Thank you very much.
Thank you.
Thank you, and bye-bye.
Bye-bye. And now I will turn the floor to Riess, who very soon will introduce the FESE de la Vega Prize, which is something that we are very proud of.
Well, thank you, Rosa. And let me also say thank you to the panelists and to you for a great panel. I think that helped to decipher a little bit Mika, Dora, T-pilot regime, digital euro. I think for me, it was really a lesson where Europe needs to go on regulation as well as innovation to really bring the digital agenda to life. And I think, as Ira was saying at the end, to hopefully be the front runner. I realize in many parts we are a follower right now, but I very much like the short, same activity, same risk, same rules line he brought it to. And this will be important for Europe to obviously develop its strategic autonomy in that sector, which we can see in many regards is not only for financial markets, but I think for our everyday life. And I think the pandemic has very much shown that very important. So thank you for a great panel. That brings me to the De La Vega Prize. And as Rosa said, there is no FESE Convention without a De La Vega Prize. We did create it in the year 2000 to encourage research by young scholars under the age of 40. And every year we have an independent and distinguished jury that awards the prize to an outstanding research paper related to the securities markets in Europe. And I would, again, like to thank very much the jury, many of whom are participating today, for their very hard work in selecting the best paper. It's not an easy task. It takes a lot of time. So thank you very much for that. And indeed, the standards this year were extremely high. So over 2 rounds of evaluation, the jury had to come up with a winner from some very excellent papers from all over the world. So without further ado, I'm pleased to announce that the winner of the De La Vega Prize for the year 2021 is Jonas Hese, the Marvin Bower Associate Professor of Business Administration at Harvard Business School, for his paper, Does Industry Employment of Active Regulators Compromise Oversight? And we're having Jonas right here. Hi there. Jonas is joining us now, and I'm pleased to say congratulations to you. I offer you the floor to give us a very short overview of the paper.
Perfect. Thank you, Rainer, and thank all of you for it's a big honor to win this prize. And yeah, Rainer, thanks you for the introduction. So my name is Jonas Hese, or Jonas Hese as a German here. I'm since 2014 a professor at Harvard Business School, and my general research interest is corporate governance, with the bigger question on how can we reduce corporate misconduct? And, part of the discussion, maybe a little bit about the background about this paper is, there was this little thing called Wirecard last year in Germany. And, for an academic, the big question is this an one-off, an outlier event, or is there something more structural that we can maybe learn about how institutions work within Europe and Germany more in particular? And, if you take a closer look at the German supervision and oversight bodies, especially when it comes to financial accounting, you realize that Germany has an unusual setup in the sense that there's BaFin, but the actual work is more or less done by this private regulator called FREP, or in German, Deutsche Prüfstelle für Rechnungslegung. And it's a private regulator, and they have this additional little twist that they allow their regulators, the active regulators, to serve on the boards of companies while they are being a regulator. So you have this concurrent industry employment, which is a very unusual constellation. And, that immediately got me interested from an academic point of view, because I think there are very good and strong arguments to say this is maybe a fantastic idea, because it's a great way to bring the newest knowledge, the most recent knowledge, the best knowledge about new accounting regulations, how to be compliant with these regulations into companies. So it could be a really great idea, and it could also be a way to attract top talent, a lot of really strong, good regulators. But of course, if you think about it, it could also create conflict of interest in the sense that you're serving a dual role, your board member and regulator at the same point in time. So what I did is essentially I tried to examine what happens after one of these active regulators joins a company board. And in short, those companies will not be subject to an enforcement action by the FRAP anymore. And at the same point in time, there's evidence that suggests that these companies engage in more aggressive accounting choices. So in short, and we can go deeper into the paper in a couple of minutes that we have, in short, it really seems that there is the risk that these dual roles can create conflicts of interest that we can oversight more broadly. And then the final thing, and then I give it back to you, Rainer, is you could say, yeah, okay, is this a big deal? And actually, if you look at it more closely, since the foundation of this private regulator in 2004, half of all the DAX companies had an active regulator sitting on their board. So that's 30% of the total market capitalization in Germany. So it is a big deal. And Rainer, that's it from my side, and I'm giving it back to you.
So Wirecard triggered this, and just maybe tell us a little bit, how did you go about the inquiry? You basically looked at board composition of especially the blue chip companies, or was that across the entire board?
Yeah, so luckily all of the data is publicly available. So essentially the data that I needed was what are the enforcement activities that this regulator is doing, and whenever there's an enforcement action, the BaFin will publish that in something called the Bundesanzeiger in German. So you can just download that data, figure out which companies were subject to these enforcement actions. Then what you can do, you can see the full list of regulators that ever served on this private regulatory body. And then there's a different data set called BoardX, where you can identify on which specific companies' boards did those individuals serve. So I figured that out. And then you just need some financial data on to come up with measures, widespread, wide use measures to capture the financial reporting quality. And that's basically what I did. Put it all together, and it's all publicly available. And the nice thing about this paper is, if you don't believe in regressions, you can just look at the actual data, and you see as soon as those people, as those companies hired some of those regulators, there are no enforcement actions anymore.
But I believe that's already a lesson that will be learned, I think, in the German legislation in the future, I hope. And it's also, of course, something that is receiving a lot of scrutiny on a European level.
Yeah, so the interesting thing is, if you take a step back, is that the first question is, who came up with the idea to delegate this supervision to a private organization? And then on top of it, who thought it's a good idea that these dual role exists? So that is something to debate. And I think in Germany, they already took steps to get rid of, especially the latter point, these dual roles. I think that's not possible going forward. But the next question, of course, is, if you look more broadly across Europe, how strong are actually the regulatory institutions across some of those countries? I haven't done any research on it, so I don't know, but maybe that's something to take a closer look at and have a critical reflection on it. And maybe why does ESMA, for example, seems to be, they have more an advising role and can't really do that much themselves. So maybe there's some opportunity beyond Germany to strengthen the oversight of capital markets.
Well, I can say ESMA has very actively looked at that. I personally am part of the ESMA stakeholder group and have witnessed that. And we've also done, from the side of the stakeholders, a quite extensive report. And I think some of the issues you're mentioning in your paper certainly have surfaced there. And I think in that sense, it's a very relevant contribution to the current debate. And I think it very clearly shows conflict of interests wherever they are should be avoided. And there, to me at least, seems a very clear conflict of interest. No, I think, thank you, Jonas. Very interested, I think very interesting paper. For those of you who are interested to read the full paper, it will be available shortly via our webpage. And I also would like to announce that it was a very difficult choice, and we decided, therefore, to basically also put another paper as basically the runner-up with a special mention, and that is Liquidity Speed, a microburst fee for low latency exchanges. It was co-authored by Michael Broley of Wilfrid Laurier University and Marius Zoikan of the University of Toronto. And again, the jury recommended that for a special mention. So congratulations to Michael and Marius. I think also a very interesting paper to read, and we'll put that on the website as well. So again, congratulations to Jonas as the winner and the runner-ups. To maybe close the day, I think it was quite a dynamic day. Thank you to all the speakers and moderators, but also a big thank you from my end to the FESE team for putting this together, to Rosa Armesto, to Stephen Gilmore, and all the other FESE staff members. A job very well done. Congratulations to the winner. But I think the day, just to reflect a bit, I think it showed that European exchanges have always been at the heart of many EU initiatives with the aim to strengthen European capital markets, and especially European public capital markets. And I think we very much look forward to working with all stakeholders on achieving the ambitions set out by the CMU. I personally believe very much the EU is at crossroads. The direction we will take will determine how competitive we are and how we're able to successfully manage the transformational challenge. We heard in the last panel about digital. We heard previously with the CEOs on sustainability. So I think this is all something that is playing into also strategic sovereignty, something we discussed. And I think that was very much the highlight of the first panel. Collective action by European and member state policymakers is needed to really ensure that European companies from large caps to SMEs can raise finance efficiently through public markets. There is a lot to do. We need investors, particularly retail, can also benefit from these opportunities that such investment provides. And I think financial market infrastructures in public capital markets are ecosystem, and they play a very central role in addressing these challenges by continuously providing finance to the real economy, by contributing to financial stability and maintaining the efficiency of transparent markets. And I think ultimately, let's see that we don't create an empty frame, as Markus Ferber said it today on the second panel, but that we empower companies to efficiently raise capital and investors to invest with good returns. And I think this is what financial markets are for. This is a social purpose we serve. And I think we need to be mindful of serving rather than, I think, putting commercial interests at first. So with that, I would like to close. Thank you to everybody who has contributed over the day, and I wish you a good evening. Bye-bye.